Well, back at it again, boys and girls. Well, folks, what's going on today? Well, what's going on today is you got a little bit of a tanky doodler. We had a couple bad sets of news. Obviously, CoreWeave not being able to find as many workers for their data centers is a little disappointing because it just slows down the rev. But what's absolutely freaking crazy to me and just blows my mind is that this morning in the freaking Alpha report said, guys, I have a feeling CoreWeave is going to dump to $90 and it's going to take the queues down with it. And this is freaking crazy, folks. This is crazy. There's my line and it's straight down to it and the queues are going down with it. Now, will it hold or is it just going to keep selling off? We'll see. But it's crazy because it's in the Alpha report this morning. Going down, baby, to 90 bucks. That was my base case. People ask me, and they're like, well, what if we go bullish? It's possible. It's always possible. If it was going to go bullish, you have to actually hold 105 and then maintain a 105 with a bounce. That wasn't the direction I was leaning towards. Kind of wild. But anyway, we spent over an hour today in the Alpha report doing analysis on stonks, and it was great. So if you're not part of it yet, I feel like you're missing out at the morning when we open up and, we hit the bell and we do our analysis and get our Alpha report cooking. So I'd love to see you there. If you haven't joined yet, make sure you go to meetkevin.com and join it. But anyway, somebody says it's not crazy. It's trading. I mean, that is true. You make a trading thesis and then you play. All right. So, anyway, let's go get to chatting about what else is going on here. So, I think the big poopy toopy today as well is this ADP jobs a weekly read, which isn't great. So you just got a couple dumps going on so far. And if I go, let's see here. This is what I'm trying to reconcile. This is just the issue that I'm having. Is ADP report October 42K. ADP report Sep25 to Oct25 negative 11K. Like, how do I reconcile that? It implies either means layoffs at end of Sept, we're still counting, or big hiring at end of October, but it's kind of weird to have the weekly report at negative 11 for the 4-week moving average when the monthly report is at positive 42. Is it possible, did some weird adjustment affect October? Did, we get some kind of recall, and this is worth remembering, recall ADP Oct was heavily driven by 37K job gains in Pacific, which I suspect was a surge of AI hiring that may not last, But anyway, you sort of have to be thankful of that side. I don't know. It's really frustrating because this is very, very noisy data. That's sort of the bottom line right there. This is extremely noisy, which isn't great. And then, unfortunately, you have to remember that this leads BLS, which we're about to get a fat dose of. Okay? So, we're going to get the October jobs report, October BLS jobs report. Then, obviously, that was delayed. We missed that. Wait, didn't we also miss September? Yeah, we also missed September, right? So September BLS jobs report, we missed that. And then, have we collected for November? So, you've got a lot of data here waiting to get unleashed, and it's so much that we already know the, what's the moving average right now? We gotta look at the let's go pull up the Nikkei. Yes, somebody says ADP usually does this. It's noisy. This is true, but you have to remember that that's why we use moving averages. And if I go look here, you could clearly see the 3-month moving average is a complete SH9T show, right? That sucks. All right. Then, hold on. I had to close all these crazy tabs from the Alpha report. Dude, we did some gnarly research this morning, I think, on jobs report on in the Alpha report. It was sick. And the fact that, like, I mean, in the market, pre-market, you know, CoreWeave was going up. If you actually go back and watch my course member live stream, you will see me say, CoreWeave's going up right now. Don't base what CoreWeave is going to do today on the pre-market. These are like words straight from my live stream this morning to course members. Said instead, watch for a big dump from institutions to 90. That's my bias. Is there a chance institutions buy the dip? Sure. But I'm leaning towards this sucker dumps to 90 and it's going to take the Qs with it. And folks, CoreWeave straight down, Qs straight down. Crazy. But anyway, what was I going to say? It was, oh yeah, we're the jobs report. Okay, so the problem with the jobs report is you've got this piece, you've got the moving average for, which we just saw for ADP from Nick T. But then we've got to get the BLS moving average. So if I get 3-month moving average, I guess I could do BLS. Let me see if I can find it here. I don't know that I can. Like, we need a moving average on the BLS monthly. And if I could find it, that would be great. BLS will stop reporting, delayed data, revisions, claims. Ah, here we go. So, oh, well, that was 20, no, that's too old. Damn. We need like the 3-month moving average of jobs, right? And the 3-month moving average of jobs should be about like 29,000. I'm just gonna have to go from memory on that until I actually find to corroborate that. But I'm pretty sure that's the moving average for the BLS jobs report. I mean, I guess I could also just look at the last jobs report. So let's do that. St. Louis Fred, labor report, Bureau of Labor Statistics, right? So let's just take the last 3 months, and we don't want all employees, non-farm payrolls. There we go. We don't want a total chart. We just want a monthly change. So give me change in thousands. There we go. Okay, and we're gonna zoom in over here on the right. Ah, there we go. See, now I could turn this into a moving average. Actually, quarterly. Ah, there we go. 3-month moving average, baby. Let's go. We just made the chart. There you go. So this goes to, oh, it only goes to Q2. Okay, because it's quarterly, right? It only goes to Q2. Okay, fine. So I will have to go monthly and then just average it myself. Yeah, dude, that's bad, right? Okay, so here's how you reconcile this. So first, because, I mean, people say this all the time, and rightfully so. Like, yes, ADP is a volatile crap show. ADP, 3-month. We'll drop that right here. And then we're gonna reconcile that with the BLS, and then that's gonna give us some guidance here. That's gonna be really interesting. So here, this is -13, 79, and 22. Okay, so this right here below is ADP 3-month moving average at 3-month moving average, basically 0, close to 0. Okay, and then if I go to the BLS moving average, BLS last 3 months reported would be June, July, August, right? Because, you know, we're missing, well, I could just grab that from the sheet here. We're missing these. There, I'll just paste that in. Yeah, drop that right here. There we go. And drop that right here. Just basically that little sheet we drew, I just pasted it over here. Okay, great. So this is the BLS report. Those are the things that are missing. And if we actually look at these numbers here, we have negative, well, I mean, look at even May. You know, if you include May, it's a disaster, but let's just do 3 months. Negative 13, 79, 22. Negative 13, 79, 22. Okay, if I add those together, I have negative 13 plus 79 plus 22 is 88 divided by 3. 29,000. That's what I said. I didn't even have to do all the math. That's literally what I guessed. Exactly 29,000. 29,000K, 3-month moving average on BLS jobs. And that's before September, October, and November. Right? If we go to the year to date would be 111, 102, 120, 158. You know, this is a lot of this is pre-immigration, right? Immigration policies. 19 minus 13 plus 79 plus 22. And if I divide that by, that's 8 months, I get a 74,000 year-to-date moving average, right? So 29K last 3-month moving average. Before that, we are at 74.7K last 8-month moving average. If break even is 0 to 20K, we really need Sept, Oct, November to reiterate positive, 3-month moving average. Otherwise, bad, right? This ADP report today suggests October positive report may be an outlier, given that moving average is close to 0. So that doesn't help. Like, none of that helps in addition to what we're seeing with, well, I mean, frankly, CoreWeave. Dude, look at that freaking bounce on CoreWeave, man. Right, like, how is that not my line? And you saw this. You know, we were live this whole time. It's not like I just went in here and drew this line. I'm like, bro, it's going to $90. That's in the damn alpha report today. Holy smokes. I mean, I'm glad it's bouncing because it would just be even worse if it didn't. But damn, that's nice. That's great. All right. So, and now we got a little bit of recovery on the Qs. That's nice. This could be good. All right, here comes NVIDIA. Okay, good. A little push on NVIDIA. I like it. Etsy. Wow, Etsy's actually up 3% today. Finally out of the hole a little bit there, huh? Yeah, SolarEdge was just down like 5% like 5 minutes ago. That's also started recovering in the last 5 minutes. Dave & Buster's at $14, slowly recovering. Tesla. Look what? Look at that. Holy smokes, dude. Within 22 cents of my line on Tesla. Bro, that's scary. The alignment of the CoreWeave and the Tesla lines. That's crazy. IREN, Nebius, whatever you want to call it. When are we actually going to see Adobe not suck? I don't know. Does anybody ever think they have a chance? Like, are they eventually here going to not suck? It'd be nice. I don't own them, but whatever. Alt's still holding. Still not at 0 yet. It's working its way towards my support line. I'll get there eventually. What do we got over here? Yeah, last 3-minute rebound here on Bitcoin, 103K. I know Michael Saylor did some serious buying again. Let's go look at how much he bought. Wasn't it like $700 million? Let's see. Let's see here. Let's see. Sailor. Ooh, the rate cut odds after that weekly report. Yeah, that's a good question. Let's go ahead and look at that. So, Michael Saylor says, here we go. They acquired 487 Bitcoin for 50 million. So that's actually surprising. I thought they would have raised more money than that. And then, of course, you know, he posts buy now. He says that before he goes and buys, which is that kind of like outsider trading? Kind of interesting. All right. Hey, Kevin, we actually opened in government before the weekend? I would guess so. I would argue that there's a high chance we reopen before the end of the week, and that nobody wants to disrupt the holidays. Dude, that I just can't believe. I don't know, man. I just can't believe that here at $98. I'm like, guys, don't trust the pre-market. The sucker's likely going to $90, and it's gonna take the Qs with it, and it does. This is insane. But anyway. Nobody wants the government shutdown going into Thanksgiving. I mean, we've been saying that for weeks. The question is just, it's not about the government shutdown. It's about all the data that we're going to get after the shutdown. That's what I'm nervous about. So, it's called stock manipulation, yeah. Where are you on the bear bull scale? Well, you can actually go to meetkevin.com/data, and there's literally, it's a free page. So I'm not trying to like sell you on it. You could even sign up for the free alpha report, or not the free alpha report, the free daily wealth report on that tab. Meetkevin.com/data. And I put the bear bull scale there. Now, I don't update that page as much as I updated it with course members, but I'll give you an idea. All right. World interest rate probabilities. We're at a 67% chance of getting a cut in December. Somebody's asking, are we going to get a data dump Thursday or Friday? No, I don't think so. I think it's going to take time. Unfortunately, how should you put it? The Bureau of Labor Statistics doesn't just like unlock the front door and then all of a sudden have all this data that spawns in. You know, you actually need to work the data. So somebody says, don't worry, Trump will have his goons fake the numbers so they look good. Yeah, I mean, it's kind of sad that we have to think about political manipulation in the data, but it's a likely reality that we do have to consider. And then it does sort of make me a little jaded, like, was the October report rigged and like now the weekly number is like the truth? I don't know. Well, I have no idea, because this negative 11,000 this morning is bad. And it just reiterates this. Again, I don't call it a cliff dive. I call it a slow bleed. It's... How should I put it? I don't think we're soft landing. I actually think the plane analogy is bad. I think we're just slowly bleeding out. Like, this economy is not going to get better. What's that disease called where, like, if you get cut, you just don't stop bleeding? What is that called? Somebody will know in the comments. But anyway, yeah, you don't stop bleeding, and eventually you're gonna die. You could get lucky for a while, but then, somebody like taps you on the shoulder and you bleed out. I don't know. It's this like terrible illness or ailment, or I don't know, whatever you would call it. But that's kind of what I think the economy has. It's like, it looks good. Somebody says COVID. You're an asshole. No, that's great. That's funny. That's a good one. Hemophilia. There you go. Hemophilia. That was it. A rare inherited blood disorder that affects the body. Easy bruising, joint pain, swelling, blah, 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 blah. Hemophilia, prognosis. Most can live full and active lives. However, they may experience joint problems. I guess maybe there are like different severities of this. Like, does the life expectancy change with this? Life expectancy. Oh, because maybe they have better like drugs now. Oh, okay, yeah, people can actually live now. Because in the past, I don't think you could. With life expectancy without treatment. Without treatments, individuals with severe hemophilia typically have a life expectancy of less than 10. Most die from uncontrolled bleeding episodes before reaching it out. The analogy is actually interesting because it's sort of like, you know, you're pumping the economy full of medicine to try to extend the life of this condition. Yeah, that's interesting. Unless well, I do think the jobs data has a risk of, you know, I really don't like that Trump just fired the head of the BLS as sort of like I mean, really what it was a threat. You know, anybody who messes with my data is gonna get fired. You say something we don't like, you're fired. I don't know, man. I'm not a fan of that. Let's see here. Okay, what is this? AI investment boom remains a hegemonic theme for financial markets. In recent weeks, my commentaries have taken a close look at the current state of tech investment and the historical impact of capital expenditure more generally. Replicate top down, blah, 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 blah. CapEx of S&P 500 firms relative to sales or the economy has yet to hit .com extremes. On a net basis, we've already exceeded them, suggesting the AI boom may be further advanced than previously assumed. On a net basis. Oh, I get it. Okay, that's an interesting line from the Doomers here. Let's write that down. So, interesting Doomer line. Somebody says Tesla. I don't actually expect Tesla to hold my line. I think Tesla is going to go down to, I think Tesla's going to go down to 414 pretty rapidly. Okay. So, interesting Doomer line from so this is from Bloomberg. It says here, S&PX firms relative to sales or economy, so that would be GDP, right? Have yet to hit 2000 levels. Okay, but compared to net income, we've already exceeded the 2000 multiples. Kind of interesting. Maybe this time isn't different. By the way, shout out to all of the folks who invested in HouseHack yesterday. I know today's a banking holiday, but we had over another like 6-figure day yesterday, which is just insane. Because let me look at the bank account, but we don't get inflows when the banks are closed. Because they don't process until the next day. But it's very interesting because I looked at the HouseHack. Oh, why did it log me out? Okay, yeah, there we go. So I went to M1 Finance instead of the bank. Okay, there we go. I guess they're just on my mind. But anyway, yeah, dude, this is crazy. So, like, the last 4 months of fundraising has been roughly like 1,900,000-ish. 1.4-ish, that's like August, September, October. But November is only a third over and we're already knocking on the door of $1 million. I mean, we're like 20K-ish away from $1 million, which is probably already funded and just doesn't hit because it's a banking holiday. Which means 1/3 of the way through the month, we've already hit our last 3 months of fundraising at HouseHack. It's kind of incredible. Really excited about it. We've bought 11 properties in the last 8 weeks, so we're averaging more than one a week right now. It's like we're the real estate treasury company. People send us money and we go buy wedge deals. But I mean, that's my job. But anyway, it's kind of wild. Anyway, this is not a solicitation. Read the disclosures and offering circular over at househack.com or reinvest.co. It's the same company as the DBA. All right. So that's an interesting little line from the Doomers here. Okay, let's see what else here. Liquidity ratio shows shutdowns and may reveal a slowdown. Let's see what they mean with this. Okay. This says the copper-gold ratio is consistent with an economic slowdown, which may become more apparent once the government shutdown ends and data releases. I mean, that is true. Financial markets love looking at ratios, cyclicals versus defensives, value versus growth, blah, 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 and then copper versus gold. But gold's also had its skyrocket. If the economy prefers copper, the economy's growing. If they prefer gold, they're fearful, that's fine. Yeah, but we've been low on that ratio for a while. Like, I don't know that that's that big of a deal, because the ratio has been crappy since what is this? Yeah, since like 2022. No, never mind. That's the ISM manufacturing line. Oh, let me show this to you. That's actually very interesting. The line has been tanking more recently. All right, let me beam this up on screen here. Oh boy, oh boy, oh boy, oh boy, oh boy, oh boy. So let's see what we have here. Open up. Open up. This is the place. Look at that. So the blue line shows us that this is actually now the lowest ratio, certainly, that we've seen in the last 10 years. You know what? Let me see if I could go further back, because they're overlaying ISM here. So let's go copper-gold ratio. And let's see if we can go back through like the prior recessions, right? So this would be... Well, here's also the global price of copper, which is worth looking at. See, recently... Wait. No, that chart stops in 2017, so that does us no good. That's dumb. Copper ratio chart. Here we go. Let's see if this website will work. Okay, here we go. So this chart goes all the way back to 1850. That's kind of cool. Let's just do this. Let's get the great inflation out of here. And let's go to like the 80s, 1980s. Holy smokes, dude. Copper to gold ratio. This can't be right. Dude, we're at the lowest level since the 1980s. Bruh. That's nuts. And let's grab a little bit more here. Yeah, the ratio boomed during the inflation of the early 70s and the economic expansion. This will let us compare. Okay, so let's just grab this. And let's make sure that's true too. But we are at... Oh, I can't even read that number. It's so tiny. Yeah, no, we're lower than then. We're lower than then. Oh, we might actually be lower than this. Yeah, we are, because that's 8.8 and that's 7.8. Holy smokes, dude. Oh, we're lower than all of these, dude. Dude, we have not been this low on this ratio ever. This is the lowest ratio in the history of the copper to gold ratio. And it is close to the lows of the 1980s. And it's typically... You know, I do wonder how much of that is just driven by, like, momentum, right? Is it possible that this is just, like, gold memeing, Costco selling gold bars, right? But let's write this down. Copper to gold ratio is now, let's go, lowest level ever in history. Usually goes down as investors prefer protection of gold and sell productive metals like copper, right? Previous lows, come on, Kevin. So previous lows we have would be COVID crash. What else do we have here? I mean, obviously, previous drops, I should say. Previous drops. The COVID crash, the 2008 crash. You've got, obviously, a dot-com crash. I mean, those are like, and then obviously the Volcker era. Though it's volatile, right? Though there are other periods of volatility. I wonder, I'm just going to make a little note. Maybe this is just because Costco started selling gold. Meme momentum. Who knows? But if I draw a line across this, maybe this time's different. If I draw a line across this, there we go. Let's just make sure the line's actually straight. No way to actually make the line straight unless I line it up with a line. There we go. Wow. That's wild. That's pretty crazy. I've put a little arrow over here. There we go. Look at that. Charting. That's crazy. Okay, so, and this is all relative to the price of copper, right? That's why the ratios are so interesting. But it does seem tweetable. Yeah. All right. I see. Copper to gold ratio hits its lowest level ever. All right, next up. So, let's go see. Hey, look, that CoreWeave bounce is still working. Holy smokes, the frickin' line, boys. Oh, my Lord. Somebody here says, Kevin, just watched your brewery video. Shouldn't we be concerned that if chips are lasting longer than expected, will hurt future sales forecasts? No, because people are always going to want the latest and greatest. And so if chips are lasting longer, it just means that there's still plenty of demand for it. It's actually a good thing. Let's see what Kevin Hassett has to say. Kevin Hassett's yapping right now.
Shutdown. I think that the estimates from CEA and Goldman are that it's going to knock maybe 1 to 1.5% off of that trajectory. So we're looking for lower growth in the quarter. The question is, when does it all come back? And I think that some of the stuff is lost forever, and some of it isn't. But I would guess by the first quarter of next year, we'll be back at the 3 or 4% growth pace.
When do we get the economic data releases? We're craving data, especially those numbers on jobs.
Yeah. Yeah, I haven't been briefed on that yet because there's been, quite a lot of disruption because of this terrible shutdown. And so, for example, I've been told that some of the surveys were never actually completed, so we'll never perhaps even know what happened in that month. And so we're going to be staring a little bit in cloudy weather for a while until we get the data agencies back up.
What do you make of some of the alternative data sources? I highlighted, for instance, last hour, the WARN notices, which are indicative of layoffs. Mm-hmm. We've seen a little bit of a spike lately. The Challenger layoff data, we've seen a little bit of a jump lately, actually the highest October that we've seen in decades.
Yep.
Are you concerned about the labor market here making a turn for the worse?
Well, the thing is, as you said, that we don't have the actual bottom line right now. But one of my old friends and one of the best Wall Street economists, Torsten Slok, put out a summary of all the labor market indicators. And on average, at his newsletter, it looked like things were still pretty positive, but not as high as it was in the first term of the Trump administration. But if you consider that we're also doing things like an immigration policy that's cutting the number of workers, the fact that we're still gaining jobs and reducing unemployment is something that we expect.
Right. That's something that came up today in NFIB. We mentioned it in the last hour. The percentage of employers who think quality of labor is the number one problem, up 9 points. That's the biggest month-on-month jump we've seen in a while. You think that is related to restrictions on labor supply?
Well, I think it's also the case that one of the things we're seeing, like you saw what an incredible earnings season it's been, because AI is making workers way more productive. We're seeing that it's making wages go up a lot, and it's also making firms more productive. I think that smaller firms are behind the adoption curve for AI a little bit, and so that probably explains why surveys can count on people saying, I wish I had better workers. I think basically what's happening is that firms everywhere want workers that understand how to use AI tools.
Agree. How much do you think AI is the investment, the trillions, how much is that driving the economy right now?
Well, I think the way to think about it, right, is that the AI is making it so that people can run their business better. I don't know if you've ever tried to defeat an AI at chess, but you can't, right? And so imagine you got this really complicated chessboard of a business, and now all of a sudden AI is helping you run it better. And that's why we just had like a record for success in terms of positive earnings surprises, because the firms have been accelerating their profitability and productivity so quickly, and the workers have as well. Really, the adoption, skyrocketed this year, and already we're seeing it in the bottom line data. And so it really is an incredible productivity boom. The productivity data, do you remember back in the computer age, everybody was saying, well, the productivity's everywhere but in the data. But right now we're looking at about 3% productivity growth. And that's probably going to revise up once we get the data better in the future. Usually these benchmark revisions make productivity go higher when there's a tech boom. So think about it. You got underlying 3% productivity growth. That means if you get labor stock growth and capital stock growth, then you're really looking at, blowout positive growth, and you're doing it from the supply side, so it's not really inflationary. So we're really, really bullish on what's going on in the economy, and really grateful for the senators that did the job and got the cooler heads and got the economy and the government open again.
But just beyond the productivity boom, which sure it's happening, just the investment that's flowing into building data centers and compute, just offsetting. It's not like the entire economy is perfectly healthy right now. Manufacturing has been in a slump for several years, contracting. Housing has been weak as well. Higher mortgage rates hurting affordability and supply too. The consumer has slowed down, and there's this bifurcation in high income versus low income. So I just wonder how much of the growth that you're talking about is really just the AI trade.
Oh, well, again, the reason that the AI firms are being successful is that their customers are being successful. And their customers are being successful because there's this massive positive technological change, which is improving the productivity of workers and the profitability of firms at a remarkable rate. And, I think that if you look at year-over-year consumption growth, it's about 6% nominally. If you look at investment, capital spending is a massive capital spending boom, and it's not just in the AI space. And so I think that the AI is part of the story, but the rest of the story is that we just had this big, beautiful bill, which was like one of the more powerful tax stimuli that we've ever seen, because it not only did the stuff we did last time on the corporate side, but also helps supply side tax cuts for workers with no tax on tips, no tax on overtime, and so on. And so we should be getting a big increase in labor supply and in investment, and that's the kind of thing that gives you a boom without causing inflation.
Although with the reopening, Goldman today says the reopening does raise the prospect of some reflation, plus the a tailwind from tax season, obviously depreciation and the bill's effects. Do you think fighting or getting disinflation in the first half is going to be a little more of a challenge than it has been?
Well, I mean, if you look at it, right, the last CPI report surprised almost all the Wall Street analysts, 48 of them, on the downside, meaning it was good news on inflation. And that number itself was inflated because there were a bunch of refineries shut down, if you're looking at the top line. And so we're comfortable that inflation has come way down, the 5% on average for Joe Biden. It's probably a little less than half of that right now. And the trajectory is really, really, really good if you look at it. And inflation is one of those things that has a lot of momentum if you look at the charts. And the momentum
Corey, back to the 90 line.
towards the Fed's.
Next test.
Even though it's been increasing for 5 straight months as of September?
Well, I guess if you look at it from January, there's ups and downs and seasonals. But yeah, it is surprised on the downside. People were expecting it to accelerate and it didn't. And I think that is because this growth that we're getting is not from like printing a massive amount of government debt and sending checks to people like Joe Biden did. I mean, think about it. If you look at
what Trump's talking
the
about right now.
macroeconomic picture, the way you get inflation down is you don't have the government spend like crazy. And we've actually got a deficit reduction so far this year that's really on track by December to be down $600 billion for the year alone. And so that $600 billion reduction in the deficit, takes the macroeconomic pressure off. But the other thing is we're doing is we're like really digging into what we could do at the micro level to go after price inflation, on an item by item basis. And so you can remember all the work we did at the beginning of the year on eggs. Egg prices are now down relative to last year, and we are looking at housing and other things that we could do to make people's lives more affordable.
Well, so I wonder how you read the message from the elections that we just had, the big wins for.
Good questions, Sarah. Good questions.
Welcome. Nice to have you. You want to talk about lovemaking, right?
Feeling that people, I know that inflation has come down from the Biden era, but it's still elevated. And those cumulative gains in things like beef prices and coffee prices, the everyday items that people face are still high. And that is something that President Trump ran on. I do wonder what sort of economic takeaways you have from the big Dem wins.
Oh, sure. You make a really great point, Sarah. And the thing is that under Biden, because the inflation spiked so much, the real incomes, which is like the real purchasing power of ordinary folks, on average, went down by about $3,400. And since President Trump took office, real incomes have gone up. That means purchasing power has gone up by about.
Losing
Oh
him.
no, we lost your camera. Oh, I was waiting to hear the answer on that one. Well, we thank Kevin Hassett. We got to most of it. Kevin Hassett is the head of the president.
Hey guys, what are you guys gonna do to solve the affordability crisis? And what do you guys think about the fact that you guys just got shellacked by Democrats?
My best point in history,
I know.
Sarah.
I was like hanging on every word. So talk to us about the inflation story and the pain that people are still feeling.
Yeah, that again, that I don't know where I got cut out, so apologies if I'm repeating myself, but because people's purchasing power dropped by so much because of inflation under President Biden, where it went up to almost 10% and averaged 5%, then real incomes, real purchasing power dropped by about $3,400 over the entire Biden term. And since President Trump has took office, we've been focusing on affordability and helping purchasing power go up. And it's gone up by $1,200 right now already this year. But people are right that we haven't actually closed the gap. We haven't filled the hole that Biden dug yet. And they're right. If you go to the grocery store, I'm the shopper in my family, and I was looking around at prices of hamburger and milk and everything just this weekend. And they're still way higher than they were when President Trump left office. And that's something that we're working really hard on.
So should the Fed be cutting rates in December? Chair Powell kind of made it seem like it wasn't a given.
Yeah, I was disappointed in what Chair Powell said in the following sense, that if you think about it, between the last two meetings, what happened is that we got a government shutdown, which was probably a surprise, and we got inflation number that was much better than expected. And so it didn't make sense that that news would make them more likely to cut in December, and yet somehow they came out of the meeting saying they're less likely to cut. And I was kind of befuddled by that statement that they were doing, and wondered again if they're once again doing something political.
Finally, Kevin, I wonder what's more likely, a $2,000 tariff rebate check or a 50-year mortgage?
Well, you know, I think that they're both really good ideas. The fact is that we've got a big reduction in the deficit. And the interesting thing is that it's not just because of tariff revenue. We've had a big positive shock to income taxes as well because people's incomes are so much higher. And so back in the summer when we were saying that for now, let's think of the tariff revenue as something that reduces the deficit, there's more room even for deficit hawks to think about rebate checks like the president talked about because we've actually done such a good job cutting spending. And the supply side effects, the Laffer curve effects of the tax cuts have actually made revenues go up. We're up about $200 billion relative to last year in revenue as well. So it makes room for it. And in terms of the 50-year mortgage, the bottom line is that it would reduce the monthly payment. We've got a real problem in America that too few people are getting that first home, and the age of first-time home buyers has gone up by about 10 years over just the last few. And so President Trump is really focused like a laser beam on trying to come up with something that addresses that.
All right. Well, that's a whole another topic for another day. But thank you for joining us. It's good to hear from you.
It's great
Kevin
to be
Hassett.
here.
Thank you. From the White House.
As we're talking, getting some Boeing orders and deliveries, let's get...
Okay, we need to talk about this. Okay. Good. Kind of wild. Because you literally, like, I want to pull this up. You literally, like, this... I don't think I'm losing my mind, but I'm pretty sure he just said that checks under the Biden administration were a terrible idea, like, you know, stimulus checks or whatever. And now checks are a great idea. I'm pretty sure that's what he said. And so what I'd like to do is just verify that's what I heard, because it sounds insane to me. How you can reconcile those two things. I mean, he's going to try to be like, well, our checks are better than the Biden checks. But let's see, because I honestly, I think I'm missing something here. So we're going to figure this out together. Hassett checks. All right. So let's go grab both these files and figure it out. Okay, so we got Hassett here. And then we got Hassett. This will just take a second here. Okay. Yeah, checks are a great idea. Okay, there we go. I got both of them. Okay, so let's just listen together and see if you can hear this.
Well, I mean, if you look at it, right? The last CPI report surprised almost all the Wall Street analysts, 48 of them, and the
Corey, back to the 90 line.
There's ups and downs and seasonals, but yeah, it surprised on the downside, massive amount of government debt and sending checks to people like Joe Biden did. I mean, think about it. If you look at
Trump's talking
the
about right now.
macroeconomic picture,
Yeah, it's right here. It's right here where he says that.
Of government debt and sending checks to people like Joe, printing not from like printing a massive amount.
Wait.
That is because this growth that we're getting, that is because this growth that we're getting is not from like printing a massive amount of government debt and sending checks to people like Joe Biden did. I mean, think about it. If you look at...
He's referencing the growth, but he's totally slamming checks.
From like printing a massive amount of government debt and sending checks to people like Joe Biden did. I mean, think about it. If you look at
That's what Trump's talking
the
about right now.
macro like Joe Biden did.
Yeah, I mean, it's basically slamming the checks. And then over here...
Room even for deficit hawks to think about rebate checks like the president talked about. Back in the summer when we were saying that for now, let's think of the tariff revenue as something that reduces the deficit. Well, you know, I think that they're both interesting things.
They're both great ideas.
A $2,000 tariff.
I'm glad they asked the question.
Finally, Kevin, I wonder what's more likely, a $2,000 tariff rebate check or a 50-year mortgage?
All right.
Both really good ideas. The fact is that we've got a big reduction in the deficit. And the interesting thing is that it's
No, we don't. We
just-
don't have a big reduction of the deficit.
Mortgage.
Well, you know, I think that they're both really good ideas. The fact is that we've got a big reduction in the deficit. And the interesting thing is that it's not just because of tariff revenue. We've had a big positive shock to income taxes as well because people's incomes are so much higher. And so back in the summer when we were saying that for now, let's think of the tariff revenue as something that reduces the deficit, there's more room even for deficit hawks to think about rebate checks like the president talked about because we've actually done such a good job cutting spending.
I mean, let's just reconcile that with looking at spending. Okay, so first of all, federal debt, United States, annual. So let's see the trajectory here. Well, that's the national debt right now, but total public debt is 36 trill. All right, let's go see. Hey, look, between Q1 and Q2, it slowed. That's good. So what is the current projected deficit? Let's see here, because I think we were looking at that yesterday with the projected deficit with the Academy Securities. Let's go see what their research was on that. Because that's Q1 to Q2, but that's during Doge cuts, and that's before Big Beautiful Bill. Big Beautiful Bill increased deficits. So that's interesting to reconcile. So if we look at Academy, here it is, paying ahead. If we look at this, was it here? Maybe it wasn't in this one. Which one was it? Here, true inflation coming back. This was them talking yesterday about yields likely going up. Part of that was because of the concern of deficits. Okay. Let's go see projected annual deficits. Yeah, I know people talk about this idea that tariffs are going to pay for the checks, but they can't pay for both the checks and deficit reduction. And that's what we saw from the Journal yesterday, which was a fair argument. So that was here, we saw that. Here, tariffs, and let's see here. Tariff, taking in trillions of dollars. Teaching moment for high school logic class. Start with the contradiction that Trump can pay both tariff rebate and pay down the debt. The annual budget deficit is roughly 1.8 trillion, even with tariff revenue. So paying a rebate would add to the national debt, not reduce it. Right, there you go. Right? So we're still going into more debt. We're still deficit spending by doing the check, if you do a check. Now we had a slowdown here because of Doge, which is good. But it's kind of interesting because Kevin Hassett is trying to imply that we're making so much money. Big Beautiful Bill, 10-year cost. CBO, let's see here. Big Beautiful Bill. Big Beautiful Bill is expected to add to the deficit by 3.4 trillion over the next 10 years. Right? 3.4 trillion over the next 10 years, which works out to about $340 billion a year. So you're spending way more on an annual basis than even the checks would cost. The checks, you know, you spend $2,000 to 150 million people. That's $300 million. You're spending 340 roughly per year. Now, of course, the idea is that, oh, but it'll grow the economy. Maybe. Hopefully. It's very interesting. It's sort of a taco. Yeah, but I mean, that, frankly, it just makes it misleading, though, what he's saying.
So I think that they're both really good ideas. The fact is that we've got a big reduction in the deficit. And the interesting thing is that it's not...
You don't, that's the thing is, you don't actually have a big reduction in the deficit. Big Beautiful Bill increased it. And we're running at a $1.8 trillion annual deficit.
Not just because of tariff revenue. We've had a big positive shock to income taxes as well because people's incomes are so much higher. And so back in the summer...
And that does great cyclically. But then, you know, if you have a downturn in the economy, that gets even worse. And then you just go even deeper into debt. Yeah, I don't know how I feel about, you know, this guy's explanations here. But what I do like is that we're literally now double bouncing on CoreWeave. So we're going to increase the size of this line now because we called it this morning and just got a double bounce on it. The Qs are now moving up. NVIDIA is now moving up. Tesla, look at that. Holds. It comes back up. pretty impressive. I do think that over the next few months, Tesla will slowly bleed down under 414, but this is pretty much in line with CoreWeave here. Pretty remarkable. But, okay. Interesting. Okay. Did you hear they're talking about, like, maybe a 15-year car loan now in addition to the 50-year mortgage? 15-year car loan. That I thought was really interesting. Let's see here. Okay, let's see here. No, okay, so some people are saying... what is this? Did people fake it? Oh, some people are saying that it may just be satire because of the 50-year mortgage argument. Okay, I mean, that's fair. That, maybe that's... Okay, so maybe. All right. I mean, the average duration of car loans has been rocketing. We've known that. Let's see here. I think we actually have a chart on that somewhere, but it's basically the number of financed loans on like 8-year loans, I think, on cars now is starting to really rocket. 7-year becoming more common. Let's see here. Duration, car loans, Bloomberg. Let's take a look at this. Yeah, okay, yeah, here it is. Look at this. Cars are so expensive that buyers now need 7-year loans. They had a chart in here somewhere. If I could get the darn thing to load. There we go. Here we go. Look at that. So you can see 7-year loans moving up. 6 years are stable. And 5-year collapsing. Somebody says, my car is my home. Can I get a 50-year loan? Lol. Imagine repossessing a 15-year-old car loan. Yeah, no kidding. Jeez, man. What a mess. What a mess. All right, let's go see the info has for us today. Oh, I also wonder if CoreWeave has posted their MSA yet. Let's go to CoreWeave's investor relations page. CoreWeave SEC filings. Not yet. Not out yet. So we'll have to watch this. OpenAI Stargate project gets a $3 billion Blue Owl investment. SoftBank sells NVIDIA. The next iPhone Air seems... I mean, people are talking about it flopping, basically. Yeah, we saw this all yesterday. So that's no news. Okay, let's try the Journal. Wall Street Journal. What's the Chinese car report? Oh, just that they're selling $5,000 to $6,000 car? Cars? I mean, that wouldn't surprise me if they are. So, progressives blame Schumer. I always blame. ADP report reports the job. I'd love to see how they reconcile this. Where was it? In the absence of official reports, investors have scrutinized alternative gauges. Apparently, yeah. Indicate the private sector lost 11K jobs in the 4 weeks through October 25th. Separately, Goldman Sachs estimated deferred government resignations could help trigger a 50,000 job drop. Dude, could you imagine that? If Goldman's right and we have a negative 50,000 jobs report for October when it eventually comes out, then it'd be like no surprise Donald Trump wanted to delay it. Whoa. U.S. non-farm payrolls likely dropped by 50K. Bro, if that report actually comes out, that's a recession. That's at least what markets are going to react with. I don't know whether it lasts or what. Holy smokes. Oh, man. calculation incorporates the bank's job growth tracker, which slowed. Wait, 50K positive? But it says shrunk. Incorporates the bank's job growth tracker. The government deferred positions likely cut by 100K. Okay, so it's, but then okay. But it's adjusting for the government separations. So, you know, people might add that back in, right? So, 50K new jobs. Yeah, I wonder where. Okay. Trump administration program was launched earlier. Thousands of staff to leave. Such a decline would be the biggest since late 2020. Government shutdown has delayed the publication of the non-farm payrolls report. Yeah, that would be a poop show. I mean, people are going to have a heart attack over that. When will the data come out? Fed policy meeting December 9 to 10. I feel like one of the reasons we're seeing such inflows into house hack is people really are trying to diversify away from stocks at these high levels because there is nervousness about the labor market, right? And the whole 50-year mortgage thing is actually kind of interesting because the 50-year mortgage is just going to really increase home values. I hate to say it, but it's like, it's not only going to be about your benefit. It's just home prices are going to go up. It's like, oh, got to buy more before the 50-year mortgage comes out if they end up doing that. Interesting. All right, well, that's not good on this jobs piece. Okay. What else? Let's see here. Okay. So we've got CoreWeave CEO responds to data center delay. Let's see what he's got. And then
The major
also we've got...
CoreWeave reporting another record quarter, revenue more than double. No, come on. You're proud of demand and that they want you, but you missed the quarter.
So I am proud of all the things that we have accomplished this quarter.
Okay.
I am proud of the infrastructure that we brought online. I am proud of the incredible progress we've made within our software. I am proud that we were once again identified as the singular best solution to deliver artificial intelligence to consumers. I am proud of our part of this quarter. Went exactly as we planned, except for one delay at a singular data center.
At a singular data center?
At a singular data center provider.
Provider, that's better because people may think it's one complex.
Yeah.
But in reality, when I go over the numbers, we're talking about multiple places, and it just so happens that the places are all connected with an outfit called Core Scientific that you tried to buy. Denton, Texas, Austin, Texas, Muskogee, Oklahoma.
That whole area getting slowed down, probably, you know what, because of a lack of workers or whatever. Interesting.
Disease erasing most of their losses from last week, driven by some optimism that the government shut down.
I think based on the fundamentals, and we watch analyst consensus expectations on a weekly basis, and they've been raising their 2026 numbers. The first and second quarters of this year turned out to be much better than they thought. They thought it was going to be kind of low to mid single digits. It turned out to be a low double-digit increase on a year-over-year basis.
Yeah, the earnings have been great. You got to give it to that.
The productivity is the story, and productivity is...
Yeah, but productivity doesn't always translate into economic growth. In fact, you could almost argue that productivity like surges right before a crash because, you know, companies are starting to cut, and so you're doing more technically with less. Wild idea. Okay. What else? Let's go with... Let's do Fox Business. Let's see what they got. See if they have anything. I don't know. Sometimes they don't. Let's see here. Still talking about Comey. My goodness. Okay. Democrats don't have a plan. I don't think there's unity in the Democratic Party. That I'm pretty confident of. China doesn't want to fix the problem. Let's listen to what he says.
Joining us now is Government Accountability Institute President Peter Schweizer. How are you, sir? Welcome. So as you think about everything that's happening, what are you sensing that Kash is ultimately trying to solve here with China?
Well, look, I think the Trump administration deserves a lot of credit for raising this issue and making it a central concern. But I think it rests on the assumption that China wants to fix this problem, and they don't. China's involvement with fentanyl is not just the precursor chemicals which come from China. That's sort of a central part of what Kash Patel is talking to the Chinese about. But it involves the production of fentanyl in Mexico. Our DEA says 2,000 Chinese nationals are in Mexico making this stuff. The pill presses that the cartel uses to make these pills come from China, and they're sold at cost. The money laundering of the drug cartels goes through Chinese state-owned banks. So it's a major problem, and I don't think China is serious about solving it.
Peter, we've followed this story for a long time, and, you know, the president has exclaimed frustration because basically with fentanyl coming up through the southern border, a lot of Americans are dying. Everybody knows somebody that has been touched by tragedy.
Fentanyl. Back off that. What is this?
The last 10 years. Are you back?
Not that one.
Do you think it's going to be till the airports get back to normal? Is it going to spread out till Thanksgiving?
Well, I think it's based on staffing, and I think it could take up to Thanksgiving to get it back to normal. It's just basically a numbers game, getting enough bodies into the different facilities, en route, Tower, and Tracon, which is the rate control. And so this lack of controllers dates all the way back to 2011. In actuality, President Trump was right when he was talking about fatigue and the fact that there weren't enough controllers. But this was actually a political move. Social engineering move made by the Obama administration, which left us approximately 3,000 to 3,500 controllers short. We're still there, and it takes 3 to 5 years to train enough controllers to get them into the system.
I mean, constant underinvestment by our politicians into our infrastructure is exhausting.
Where they're effective. So that 3-year period, basically, where the FAA didn't hire controllers that were controller applicants who are well trained and ready to come into the system, we're still dealing with the residual effects of that. Unfortunately,
I'm sorry to interrupt you, but I'm not familiar with this. Whatever happened back in 2011 with Obama and the air traffic controllers.
It's just underhiring of infrastructure. Okay, that's fine. So what else do we have going on here? We'll show the credit card. The credit card rule. This was somewhat shocking. I'm going to talk about this for a moment. Well, let's at least look at it together. Okay, premium credit card users are in for a big surprise. Their JP Morgan Sapphire Reserve could soon be rejected by merchants. Did you, by the way, see that? I think it's the Attorney General of Florida is now investigating JP Morgan. I couldn't be happier. Attorney General of Florida, JP Morgan. Yeah, look at what we have here. Florida Attorney General probes JP Morgan Chase over alleged debanking of Trump media. Florida Attorney General announced Monday that his office has launched a probe into JP Morgan following reports of a Biden-era FBI investigation that targeted the Trump group, coordinated with Agent Smith during Arctic Frost operation, which led JP Morgan to debank Trump's SPAC at a critical time. Oh, that could be a setup for if Trump's like, oh, we lost money because of the debanking. Yeah, look at this. Almost immediately after the Biden DOJ fishing expedition began, JP Morgan began in questioning the Trump media group. This was a fact-gathering due diligence. The timing and termination of its relationship with the Trump Media Group raises the obvious and troubling questions. Fraud, civil anti-fraud laws and debanking prohibitions. Breach of basic fundamental duties owed to your banking customers. Preserve all documents. Wow. Dear Mr. Diamond. Look at that. That's interesting. Okay. A settlement between Visa and MasterCard and merchants over a 20-year legal battle is crossing for the first time a red line for the credit card industry by breaking the network's rule that forces a store to accept one Visa credit card and therefore accept all. Ooh. The deal was announced Monday, confirming an earlier report by the Journal. No longer would merchants have to, quote, honor all cards. Instead, they can reject cards. Yeah, see, what we've seen is investors will actually invest in HouseHack with a card because there are no fees. And as far as I'm aware, they pay it off right away, but they get their points. I don't think you should borrow on a credit card to make an investment, right? That's crazy. But I think people are like, dude, I could get like 2% cash back investing in HouseHack, like hell yeah. And so like there's swiping double cash cards or reward cards or whatever, or trying to hit spending limits on cards or to get bonuses. And Amex actually fails. Amex gets rejected. Amex, I guess, just doesn't allow you to get points or whatever on securities transactions or whatever it is. But it's interesting because I'm just thinking about that. Like, I guess if you're like at a coffee shop or I don't know, a clothing retailer or whatever, you could be like, oh yeah, I'm not paying for those fees. But I also didn't know the fees were different between individual Visa cards. So what are the interchange fees for different Visa cards? Interchange fees. Different Visa cards. Yeah, you get 3% on the Robinhood Gold card. Yeah, no kidding, right? Because that, dude, 3%? And you're investing? Bro, that's sick. So, Visa, reimbursement fees, interchange. Visa fees. I guess it depends on the type of card it is as well. So, man, Visa has a lot of fees. I'm just looking at this document here. This is an insane number. It's just like this insane list of fees. Interchange fees. See, commercial level 2, travel service, large ticket, various different types of merchants, restaurant, advertising, all different fees. Oh, here you go, traditional rewards. Oh, look at this. How interesting is this? So if you do the Visa Infinite Spend, not qualified, the interchange rates are, I'll go to advertising. 1.85 for this, 2.4 for this. Yeah, so they do charge. The point is the fees are different, right? Depending on the type of card. Yeah, it could be like an extra 50 cents or 50 basis points, right? That's crazy. Somebody's like, have I gotten the Robinhood card? No, I have not gotten the Robinhood card. It's oh, I don't know. I just guess I haven't gotten invited. But it's all right. Okay, so I guess they do charge different fees. Instead, they can reject credit cards that charge merchants a bigger fee for each transaction. A concession Visa, MasterCard, and banks have balked at for ages. Right. I mean, because you could have a list and be like, we don't accept the Sapphire card anymore, or this, that, or whatever. Oh, the audio go weird again here. There you go. That should solve it. All right, let's see here. Some big banks were furious about breaking the rule, according to people familiar with the matter. For consumers, this means many of the rewards cards they've grown addicted to can be rejected, while other low or no-frill credit cards, which tend to be cheaper, would be accepted. Wow, that's going to get complicated. Yeah, you do need an invite for the Robinhood Gold card. Because there's a wait list. So if you go on the Robinhood app, so maybe you just got invited and then you think it's just the application's open for you, but you actually are lucky because you have an invitation. If I go to credit card, you are on the wait list. We'll let you know when it's time to apply. That's what it says. Interchange can range from 1.2 to 2.8. Wow. Yeah. If you have an audio issue, just hit refresh, like Command R. Yeah. This change could impact a majority of credit cards, so merchants would face a difficult choice, upsetting customers, rejecting certain cards. A merchant could merchants possible blacklist many airline and hotel cards. Okay. The cost coming. This is quite interesting. Interchange income has fueled the expansion of rewards. Right. In a lawsuit which dates back to 2005, merchants sued Visa and MasterCard, alleging that they engage in anti-competitive behavior with the interchange fees. So this now breaks the honor all cards rule. Cards will fall into 3 buckets they can choose to accept or not. The buckets are wide. The most popular cards that make up the majority of spending are grouped together on one card, making rejection a risky prospect for the store. Right. Okay, so it's 3 buckets, basically. More merchants, and especially small businesses in recent years, have begun to pass on the interchange fees by charging them more when they pay with credit cards. Yeah, but that's, I hate to say it, but it's one of the uncompetitive advantages of small business. Still, the agreement could face more challenges in court. Early indications and trade groups is the settlement doesn't go far enough. The battle may not be over yet. Let's see what they say here. Merchants, cancel reward cards at your peril. You eliminate the option to pay with a reward card. You might as well put a bankrupt sign on your door. I kind of agree there with this. Nobody needs to shop there. Well, unfortunately, that's just one of the competitive advantages of Amazon, right? So one of the, I'm going to write that down, competitive advantages of Amazon or big companies, they can pay to set up store cards and give you 5% back with the store card. A small business won't have that. So by default, Amazon's probably going to be cheaper. It sucks for small business, but it's something worth considering. It's sort of unfair, right? Think about it. If you buy $100 object, no tax, let's say, on Amazon with 5% off card, that's $95. If it's $100 in a store that charges you a 2.5% credit card fee, that's $102.5, right? The difference between the two is that like 107 or sorry, 7% or something like that. I'm paying 102.5 divided by 95. The difference is 7.9% difference in cost. That's insane. It's kind of crazy if you think about it. It's sort of like rip small biz, right? It's unfortunate for small biz. But, oh, damn, let's go on that CoreWeave bot. And this is, I tell you, folks, this is why you want to be in the Alpha Report. Like, you joined this morning, you watched that course member live stream back this morning. People were like, Kevin, what do you think? We're going bullish or bearish? I go, I'm bearish on a sell-off on CoreWeave down to $90. Perfect double bounce. And you saw it live, too. Like, it actually happened. It's kind of cool. Okay. So, I mean, that's interesting. I wonder what other people are saying on the card issue. Big story here is the 20-year legal fight. Yeah. Lining attorneys' pockets for 20 years. Yeah. Problem with Visa, MasterCard, they created themselves both publicly traded and have to grow. They only have so many levers to turn. Turns out they've overplayed their hand. As a consumer, I'd rather pay 1% less at the counter than have some rewards game to play. Well, yeah, that's one of the benefits of the cash back cards now, right? Like, you know, the Citi Double Cash card or the, Apple card. Like, these are great. Very interesting. Nvidia and Qs are struggling a little bit to get that Qs bounce in there. I wonder if you'll get another sell down right at the close. Tesla's struggling at the line too. See what else here? ServiceNow, Rivian. Rivian's at $17 now. All right. What else we got here? Saw the JP Morgan suit thing. Let's go. Let's see what The Economist has. Well, The Economist has some bear article. From 1300 to 1800, economists estimate that Britain was in recession half the time. Wow. That's crazy. Today, recessions have become something of an endangered species. I mean, that's a good thing. You don't want a recession, right? Recessions are really painful for people. Okay. Past 4 years, the world has faced challenges of unusual scope, from high interest rates and a banking crisis to trade wars and hot wars. GDP growth, that's fine. Aside from a contraction stemming from COVID-19, the world economy has not suffered a synchronized recession for over 15 years. Perhaps a third of America's workforce has never had a prolonged downturn. Well, actually, this is actually very interesting, because if you consider that individuals who are investing in the stock market today are primarily, I think, taking leftover money from their paycheck every week, if they have that, and they invest in the stock market at these high valuations. The risk is that a lot of people don't even believe recessions exist, and people are like, oh, there'll never be a recession again, because they've never actually been through a recession. That's crazy. Slumps can extract a tremendous human cost, correct. Yet there's a catch. When the world moves through a recession, costs begin to mount. What's a recession? Oh, like a lack of growth in recessions. This is a recession. That's actually funny. Some suggest that the economy needs the occasional downturn to stay healthy. Recessions provoke creative destruction. Failing firms exit the market. I mean, it's sort of like a hurricane, right? That cleans stuff up. The idea feels intuitive. It's like a detox. Okay. Let's see here. You kill unprofitable stuff. Blah, 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 blah. What do we have here? America, by contracts, let jobs die, but give people oodles of cash. American politicians thus encourage creative destruction, with workers moving where demand was growing. And then GDP grew. Okay, fine. Recessions fail to provoke creative disruption. Japanese bubble, fine. Recessions are guaranteed to be painful. It's hard to know if the next downturn will be a cleansing act. Productivity destroyer like the Great Recession. Okay. Fiscal policy may have stopped demand from collapsing, but the intervention may be so large that politicians are distorting the economy's allocations of resources. The longer a recession continues, the more three risks grow: financial, fiscal, and allocative. Okay. Financial risk. Long stretches without downturn foster disaster myopia. A tendency for people to forget that bad stuff can happen. Yeah. Households appear oblivious to the fact that things do not always go up. Yeah. 30% of American household net worth, all-time high, is exposed to the stock market. A correction would cause serious pain. Also true. Second risk is fiscal. Government efforts to insure against a recession are expensive. Correct. The debt goes through the frickin' roof when you have a recession. The bailout state, basically. Okay. And then there's the allocation risk. Oh, yeah, the growing rise of zombie firms. Yeah, I mean, you look at IWM, and it's like full of zombie firms. Economists once argued zombie firms were a product of low interest rates. Yet even as rates have risen, so have the ranks of the undead. The undead, I love that. Zombie firms grow their influence when it becomes more aligned in 2022. Like, I mean, I hate to say it, but I feel like some of the quantum companies that have skyrocketed are like zombie firms. Yeah, I mean, look at, I don't know, you have to go look at some of these, like, I don't know, QuantumScape, investor relations. Let's go on over here. QuantumScape, third quarter results. Yeah, where are they, bro? SEC filings. It's been a minute since I've looked at their filings, but let's go take a peek. Let's see what we have. Yeah. All right. So net loss of $100 million, literally no income. Okay. QuantumScape doesn't even make money. The only way they make money is by issuing stock. Okay. And that's how they raise money. And a lot of it, I mean, they got like $1 billion in cash right here and not that many bills to pay. Right? So this is very, very, very strong balance sheet. But that is an example of $1 billion going to a company that doesn't even have revenue. That's insane. Like, how is that not a misallocation of resources? Mind you, like, over the past days, it's like, you know, since June, it's just blown up. But that's an example of a misallocation of resources. It's crazy. Rigotti, I think that's another one. Rigetti. Oh, well, they've actually started finally coming down. I think IonQ is another one of them. You know, but let's look. RGTI Investor Relations. Let's go look. I mean, let's let them speak for themselves. And like, these aren't like brand new startups either. These are like, I'd just like hope plays, I guess. Yeah, dude, look at this, dude. This is insane. Net loss of $200 million. Well, some of that was because of warrant liabilities. But loss from operations here, $20 million compared to $17 million last year. Look at their total gross profit, $400,000. $400,000 gross profit in the last 3 months. Dude, I made more money than them in the last 3 months. I'm one person, okay? This is insane. So, cash flow, look at this. They just sell the stock. That's all it is. At the money offering. That's it. Because they're losing money like crazy. You know, that's a misallocation of resources. Okay, what's another one? IonQ. They're just memes. You know, it's ridiculous. SEC filings. Which is fine. Like, you can't go in there and short it. So you have to be careful because, you know, the meme stuff is very powerful. At least IonQ has revenue, but what the hell is going on with the expenses? Oh, wait, I'm sorry. Never mind. They don't really have revenue. $39 million of revenue, $208 million of expenses. Holy smokes. Oh. Where are they getting money from? Geez, can I guess? Can we guess where they're raising money from? Would it possibly be from issuing shares? I don't know. Let's look at the cash flow statement. Oh, shit. $1.3 billion of shares issued. It's crazy, man. Somebody else was saying qubits. Probably another one. Oh, the D-Wave. Oh, yeah. I mean, quantum annealing play. Yeah, I mean, it's another meme play, right? Like, I'm not trying to shit on it, but I'm trying to tell you, like, don't invest in it for fundamentals. It's a piece of crap for fundamentals. So let's go look. Revenue, $2.6 million. Expenses, $27 million. Net loss, under $39 million. I wonder where they're getting their money from. Could it possibly be from issuing shares? Proceeds from issuance of common stock, $500 million. Proceeds from issuance of common stock, $139 million. Proceeds from the issuance of common stock, $37 million. Oh, shit! It's a joke, man. Oh, goodness gracious. I need to go to the bathroom. I'm gonna go vomit really quick. I'll be right back.
This is the market cap for all tokens. It's flat this year after it did touch a record of close to $4.4 trillion. That was at its peak in early October, Scarlett.
Yeah, early October was the turning point there. And with signs of fatigue in Bitcoin and the rest of crypto, we've been tracking what veteran short seller Jim Chanos has been up to. Several times this year, Chanos sat down with me to discuss his long-standing wager against Michael Saylor's strategy, which is, of course, the original Bitcoin treasury company. Here's what Chanos told me most recently in October.
We're agnostic on Bitcoin. I have no idea where Bitcoin is going or what it's worth, but we own Bitcoin against the MicroStrategy short. This was an arbitrage. And we just, as you know, we just weren't and aren't believers in this whole concept of Bitcoin treasury companies trading at premium to the underlying asset.
And you say that MNAV should be at 1. You advise clients when the MNAV was between 2.2 to 2.3. Have you covered any of your shorts?
We have not covered any of our shorts. But, you know, again, we reserve the right to change our mind. But I I think as long as MicroStrategy keeps selling its paper to buy Bitcoin, we're going to do the same thing that they're doing.
Now, over the weekend, we learned that Chanos exited this position, writing in a post on X that, quote, as we have gotten some inquiries, I can confirm that we have unwound our MicroStrategy MSTR Bitcoin hedge trade as of Friday's open. His disclosure came as the premium between Strategy's market value and its Bitcoin holdings narrowed to its tightest in more than a year. Chanos had bet against MSTR through a pairs trade, shorting Strategy, the stock, while going long on Bitcoin on this view that the company's crypto holdings did not justify the inflated share price. Tim?
I want to bring in Bloomberg's Monique Malima with more. She joins us this afternoon. Monique, I'm curious about the strategy, like the idea that a digital asset treasury company has these assets, but they're valued at a premium to the actual core value of the assets and how they're traded in the open market. What is the sale that these companies are making? Why should investors value them more?
So a lot of these companies were saying that they're offering leverage. So part of MicroStrategy's whole strategy around how that they would purchase Bitcoin was that they would issue debt and they would issue securities to fund these purchases. So because of having that debt leverage, that would mean that when Bitcoin would overperform, the thought would be that a digital asset treasury would overperform. And also, unfortunately, then the opposite. When it underperforms Bitcoin. So that's how they were kind of selling this to investors as a way to have that leverage for it. And it also offered opportunities. There are some people who maybe can't or don't want to directly purchase Bitcoin. So then they could purchase through a stock like MicroStrategy, where most of the business is just buying and holding Bitcoin.
Monique, what is Michael Saylor, what is Strategy saying or doing now, not in response to, but to kind of explain how the premium has narrowed?
Sure.
Well,
how to go vomit. The strategy play makes sense. Eventually, it's like, how much of a premium should MicroStrategy really be selling for over their Bitcoin holdings? Not much. We don't really do anything. But whatever. What are you going to do? All right. Try to put some of this together. So. Maybe we'll do that in a moment. Let's just quickly go see if there's anything else that's new out there. And we can summarize some of the stuff. So, what else do I have? SoftBank sells us today. We saw that. Airlines warn of flight cancellations. All right. Oh, it says Politico says Trump insists the GOP won the affordability battle. That's a good one, Trump. Okay, what about the Journal? Anything else over here? I don't think so. We have Senate passes measure to end government shutdown. We saw that. The priceless credit card settlement. Oh, okay. Let's see what the editorial board says about this. Because that actually goes back to here. Okay. So, the agreement will slash settlement. The agreement will slash the average fee by 10 basis points for 5 years. Cap the rates of standard cards at 1.25%. And give merchants more discretion. Oh, interesting. So, the bucket of standard cards will be 1.25%. So, that means there could be like a 1% difference. Oh, that's interesting. Card issuers charge merchants a fee for processing and payments. On average, is 2%. So you could just reject all the non-standard cards. Honor all cards rule was the old one. Customers also tend to spend more with credit cards than they would if they had to pay with cash or debit cards. And even more when they use generous rewards. Right. Well, that's like the desire of these credit card companies doing all these rewards and stuff like that. It's all designed to get you to blow blow more money. Like, man, if we had to pay cash for everything, dude, we'd spend a fraction of the money we do. Maybe that's the way to go. You want to save money? Just cancel all your cards. Cancel everything. Go pay cash. But what a pain in the ass. Merchants have largely benefited from the broader use of cards. Monday settlement. Let's see here. Payment apps like PayPal and Venmo are increasingly competitors to credit cards. Some small merchants have been steering customers to pay with apps to avoid interchange fees or give discounts. Oh, that's kind of smart. That's great. That's actually a good idea. Like, hey, just Venmo us. I mean, I'll like Venmo or Zelle, vendors pretty regularly. Like, I just paid for quartz countertops with Zelle. That's it? That's all I have? I wonder... Businesses can work out their agreements without government intervention. Well, yes, in only 20 years, under the threat of litigation and government action. Oh, yeah, I love the comments. Okay, let's see what people say about it. Credit card interchange. Let's see. Well, this is an interesting argument. Look at this. This person says Europe killed credit card points in 2015 when it capped interchange at 0.3%. That's the pot merchants pay to banks. After 2015, rewards shrank, airlines dropped co-branded cards, and banks pivoted to perks like travel insurance. In the US, we kept high fees, so every time you swipe, merchants are quietly subsidizing your flights at the expense of those who don't use credit card rewards. Yeah. The reality is even more curious. Europe does not use credit cards much, mostly debit. Maybe. I think the Robinhood 3% card is heavily subsidized. I mean, it has to be. So then the reality, like, I wonder actually if Robinhood discloses this. Investor relations, Robinhood. Let's see. It would probably be their annual, if they even segment it. They might not. Annual report. Let's go with credit. Okay. Credit Gold Card program is offered under an agreement between Coastal Community Bank. No annual fees, blah, 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 blah. Okay. It's a way to acquire customers. You know, it's like a lost leader is my guess. But it'd be very interesting to see if they have any disclosure on the fees here. I don't think they will. Default risks. Oh, what was that? Nope. Tax credits. Not that. Credit facilities, no. Provision for credit losses, fine. Credit cards. Ah, here we go. How interesting. What do we have here? Net interest revenues. Oh. Interest expenses related to credit facilities. The same amount as the credit card revenue, but credit card net. Net interest revenues as a percentage of total, 1% for the credit card. Interest expenses related to credit facilities, the same 1%. That's interesting. I mean, the credit facilities is kind of a catch-all, though. credit card. Revenue, 24 mil on the credit card. But are they going to provide expenses? Just the credit card. Credit card net consists of an off-balance sheet amount representing customer principal amounts at Coastal Bank. Robinhood collects interest from the balances and pays interest to Coastal Bank. Ah, that's through the credit card facility. $202 million was the off-balance sheet amount. Includes interest expense related to our credit facilities for the credit card. Yeah. Provision for credit losses. Credit card losses, 55 mil. But they didn't even make that, right? Like, they made 24 mil on credit card interest. And then they still have to pay interest. So their credit losses are actually a lot more. So they're definitely subsidizing the card. There's no question of that. All right. I think that's pretty clear. I don't think we need to look at this much more. We could see that, and the benefits the customer, right? Provision for credit losses. And then, of course, here we could see the interest income and expense on card and card related facility. All right, yeah, that's not a surprise. All right, what's going on over here in L Market? Almost 92 now on CoreWeave, still rebounding, barely. It's trying to stay alive. Okay, cool. So I don't think anything's gonna happen anytime soon, honestly. It's going to be complicated, but I want to know what the 3 settlement buckets are. 3 settlement buckets, credit cards. Ah, the 3 buckets are commercial, premium, and standard. Oh, so they could dump the premium theoretically, right? That's interesting. 3 different buckets, commercial, premium, and standard. I wonder how many are in each. Declining the Sapphire might be worth it for their bottom lines, but risks alienating 20% of households that are driving most of the spending, says Moody's, who are more likely to carry premium cards. Right. I mean, but most people also have another credit card. Like, I don't know of a lot of people who only have one credit card. That could actually be like a thing we can Gemini look up. Like, of people who have credit cards, how many only have one versus multiple in wallet? Just a quick Gemini look up. So about 25% of people only have one card is what it guesses. All right. And higher income individuals are more likely. Well, that was our anticipation anyway. So that higher income individuals would have more cards. Exactly. If you're paying for the premium card, you probably also have a free card that you could use. All right. What else? So we're going to talk jobs. Briefly talk credit. Oh, Dave & Buster's is bouncing. It's $14.20. Yeah, the Sapphire is that $800 fee. Yeah, that's why I prefer right now. I have an affiliate link for it, but that's not why I prefer it. What is it? The travel card? Is that the button? Oh, the button doesn't work. Oh, there it goes. Oh, look at that. Best travel card. Why is it going so slow? I gotta figure that out. MeetKevinCapital.com/Capital One. That's my favorite card right now. You know, absent like or outside of the.
That's why.
Oops. Yeah, I gotta fix some of those transitions. Outside of the Robinhood Gold card, but I actually prefer this Capital One over the Sapphire right now. Okay, so what else is going on in the news? I don't actually think that much. Consumer Financial Protection Bureau is claiming it can't draw any additional funding from the Federal Reserve. Federal Reserve currently collects. Okay. Wow. Vote is going to work. Bureau may not legally request funds. Wow. They're basically going to collapse at the end of the year, if that's true. Wow. Trump administration declares Consumer Financial Protection Bureau funding illegal. I mean, that's like right along the Project 2025 lines. That's crazy. Okay. What else? Okay. So, see if I can look at that Politico piece. Consumer Financial Protection Bureau disclosed in a court filing late Monday marks the administration's most direct effort to dismantle the consumer watchdog. Legally bars them from seeking more money from the Federal Reserve. Wow. End of the year, but expects to exhaust its money by the end of the year. Yeah, and that started at the end of the last financial crisis, is when they made this. They just ripped its funding. Huh? Yeah. That's what people wanted, I guess.
Hyperscaler bonds, noting that the cash flow was insufficient to fight the AI arms race. Credit rating agencies so far are increasingly concerned just in idiosyncratic situations. Moody's, for example, recently warning that Oracle's CapEx plans could cause debt to increase faster than EBITDA, which could create negative free cash flow. But Moody's stopped short of taking any type of ratings action. Scott.
Yeah, so to be continued. I'm sure we're going to have many more conversations about this. Les, thank you, Leslie Picker. Anything to see here?
Yeah, I think tech issuance around investment-grade corporates, that's been a big part of corporate investment-grade portfolios over the last number of years. It's been a high free cash flow, strong balance sheets, to Josh's point. I think our concern is that credit investors actually push the scrutiny on some of this investment maybe faster than equity investors do, because now we're starting to look at things like weighted average cost of capital, return on invested capital. These aren't things that these companies were ever asked to do.
Kind of like Josh is talking about, the way you look at these maybe has to change.
And the
aperture has to be open a little bit wider to see more of the picture.
Right. And the overarching quality of tech issuance could come into question over the next year, as there's just so much of it and there's so much CapEx going into the ground.
I actually think it's more dangerous than just the impact on how we rate these stocks. I think there is a large and growing segment within my industry, the wealth management industry, where a lot of financial advisors have been rallied to this flag of the new 60-40 is 60-20-20. And a lot of them have been incentivized to start retailing private credit products that perhaps they don't fully understand or are so new that we have not seen them through an actual economic cycle. Remember, it's been 15 years or so since we've actually had a traditional recession or economic cycle. And now what ends up happening is you think you're diversified because you're 60% stocks and it's not all Mag 7 and blah, blah, blah. But then within the fixed income piece, you've bought so much product that your branch manager or your complex manager told you to buy And then you realize, oh my God, I have equity risk on the Mag 7 and this whole AI theme, fine. But look, now a decent sized portion of my corporate bonds or my fixed income is also at risk based on the same premise of this AI build out. I'm not suggesting like people put 20% of their clients into private credit products that are building data centers, but it's definitely more than it's ever been before. So I actually think that there are some risks being taken out there by people who are supposedly fiduciaries, and maybe not all of those risks were wise in the context of a retiree's investment portfolio.
Here's what I think is interesting. We've heard a lot in the last several weeks about AI stocks using the debt market. What's the response to that? What's the market reaction to that? Perfect example, obviously, is Oracle. Now, you can make the argument, and it's factual to say, that the demand for the investment grade bonds that they offered was remarkably strong. You could also say that it's a small amount of capital that they're raising relative to their overall size. But
yeah, all right. Well, I mean, the problem is the free cash flow disaster or destruction that you're seeing at some of these companies. Let's see here. Okay. All right. Cool. Let's break down some of this insanity that's going on while understanding what's going on with L market. All right. So here we go. So why is the market going a little poopy doopy and squirrely today? Well, a lot of it has to do with what Goldman just said about jobs and what ADP told us, along with other uncertainties, like, of course, CoreWeave telling us that multiple of their data centers just don't apparently have enough people to complete their jobs, and therefore they have to delay revenues. And that was something that took away a little bit of a supportive toothpick for the economy. See, I've been of this mindset that the economy is sort of like this giant built-up dome of success right now. The problem is a lot of that support feels a little toothpicky, like there's not a lot of support to it. And the way we reconcile that is by looking at these actual jobs reports and trying to look under the hood to see, well, what's going on in here? What did we get this morning? What did Goldman just say? We're going to talk about that. Also, though, I got to shout out the Alpha report, because this morning, while the market was green on CoreWeave, or at least we were recovering here on CoreWeave, I said, don't trust the pre-market. I have a feeling institutions are going to dump CoreWeave and it's going to fall to this line right here, 90.07. It has not only done exactly that, and the Qs have gone red with this, which is something else we expected, but we've gotten a double bottom on that line. You actually watch my live streams, you'll see this happen. You know these lines have been there for a while. That's pretty remarkable. So if you don't have the Alpha report yet, go to meetkevin.com and join that. Make sure you get all the courses on building your wealth and the Alpha report delivered to you every day before the market opens up. So anyway, what's remarkable here is the jobs data and the economist warning on, hey, is it potentially time for a recession again? Nobody wants to hear that, but look at some of the Goldman data this morning. Goldman comes out, and the Wall Street Journal put together a good piece of this, but Goldman came out this morning and suggested that we might actually be at negative 50,000 jobs for this October jobs report. Now that's not good. That piece is right here. The U.S. likely lost 50,000 jobs in October, Goldman Sachs says. Now, that's their estimate. Now, remember, we're missing a lot of actual labor data, right? If we jump over to some of the numbers we were putting together this morning, we can actually see the trends of this. So first of all, look right here. These are all the reports we're missing right now. We are missing November, October, and September. Those jobs reports are missing. So the only thing we can do is we can look at the official labor reports for the United States. And this has been the trajectory of the official labor reports. Straight down. Usually once we fall under 100,000, we're pretty close to a recession. However, we just had a little bit of a wrench thrown in the gears. We had a massive deportation shift, a closing of the borders, and a huge change of immigration policies. As a result, what you end up with is this collapse in average jobs created in the United States, where in the last 3 months of jobs data that we've had, we've actually been at 29,000 jobs, which is pretty low. So if you look at the data here, from the beginning of the year on, so if we started January, we've actually been closer to creating about 74,000 jobs per month. That's collapsed down to 29,000 jobs per month in the last 3 months. Now that could be normal because maybe that's where the break-even labor report is. But negative 50,000? That would be well below the break-even rate and a warning sign if we actually get this. This is one of the reasons I'm bearish for after the economy reopens. I don't actually think that we're going to get the economy, like the government reopens. It's not the economy. The government reopens, and it's not like we're going to get the data right away. It takes a while to compile all of this. But once the data comes out, that's probably the biggest bearish catalyst that we have to get through. We have to get through that catalyst of getting all this data. Specifically, we're going to get the September jobs report and the October jobs report. Those are already due. And then we're going to get, in the first week of December, we should be getting the November jobs report, which will be right before the Fed meeting, which right now we are only pricing in a 67% chance of a rate cut. But if we end up getting a negative 50K October report, ouch, man, that's going to suck. And markets are going to panic over this. Now, there are details to this, and we've addressed this as well in the past on the channel, that people might try to add back in the loss of government jobs. Okay. Well, according to Goldman Sachs, the loss of government jobs was 100,000 positions. Well, in that case, you'd have a BLS October report that aligns at 50,000 with the ADP report at 42,000. But this is where we're kind of like, okay, well, which is it? Because when we look at the ADP report, we also get mixed signals on the ADP report. Because the ADP report on the weekly basis that we got this morning is like, oh, hey guys, the ADP report on a weekly basis between September 25th and October 25th is negative 11,000 on an, sort of a moving average basis here. But the ADP report for October told us we had 42,000 jobs, 37,000 of which happen in the Pacific Coast, mostly in tech jobs. So then it makes you wonder, okay, did we get a bunch of hiring at the end of October? Was there like a hiring boom in the last week of October that's not reflected in this year? Or were there a bunch of layoffs at the end of September? Like, what's going on here? Because now we're being told it's negative again. The numbers are all freaking over the place. And it's really annoying because it's like, well, which damn thing is it? It's like, yes, the ADP trend is trending down. Yes, the BLS jobs report is trending down. But maybe we can explain it away with immigration, and therefore maybe it's not that big of a deal. But of course, the big question then becomes, will it last? Well, that's where The Economist comes out and puts together a pretty interesting piece. The Economist argues that recessions have kind of become recessions are in recession. And there's this idea that because in history, we've had so many more recessions, like from the 1300s to the 1800s, we were in recession 50% of the time. Then we were in recession 25% of the time. Now, we've literally not been in a recession for over a generation, over 15 years. They say as many as 1/3 of American workers have never experienced a recession. And therefore, we might actually be experiencing a recession right now, which removes the sort of clearing of like dead and zombie companies, and then also increases pain, especially when you've got people who are more allocated to stocks than they've ever been before. But it also raises up zombie companies. So The Economist, they make this interesting point. There are three big problems that come. First of all, when you don't have recessions for a while, people forget that stocks don't only go up. This is why I keep advocating, like, pay off debt. Things are really noisy right now. We could teeter in either direction. 30% of American households' net worth is exposed to the stock market. We're at an all-time high with exposure to the stock market. Margin debt's at an all-time high. Credit card debt's at an all-time high. The government fighting recession is just going to increase massively fiscal deficits. And on top of that, the number of zombie companies that we have, even under high interest rates, is skyrocketing. I mean, we were just doing a little analysis on the live stream. We're like, dude, Look at some of these zombie companies. QuantumScape, no revenue, net loss of $105 million. How do they actually stay alive? Because they issue stock. They meme up because they have quantum in the name. They have no revenue, and then they issue $250 million of stock because they're a freaking meme. Let's put that one away. Let's go look at another one. Rigetti Spaghetti Computing. Gross profit, $404,000 in the last 3 months. Kevin's gross profit is more than $404,000 in the last 3 months. This is insane. Rigetti Computing, okay, there are no real revenues here. This is insane for a company. Loses money, $20.5 million in the last 3 months, $17 million in the last 3 months of the same 3 months last year. Even more if you include the change in fair value derivatives. Where do they actually get their money from? Oh, they get their money from issuing stock. What do we have over here? Oh, look at that. $346 million of stock. This is how you get a misallocation of resources. You get meme stocks and you don't end up getting the flushing out of these zombie companies that don't actually generate money. So you have, here's another one, IonQ, $39 million of revenue, total operating costs, $208 million of operating costs. $82 million of it, general and administrative expenses. Yes, they spend 82 divided by 39. They literally spend $2 on G&A for every dollar of revenue that they earn. And so how do they stay alive? Not by making money. They stay alive by selling stock. That's all they do is they sell the stock. Look at this. $1.3 billion of stock raised. It's insane. Here's another one. What's this one? D-Wave Quantum Computing. What do we have over here? Well, let's just go see. Let the revenue speak for itself. D-Wave Quantum Computing, which is annealing quantum computing, which isn't really quantum computing. Total gross profit, $2.6 million. Loss from operations, $27 million. Net loss, negative $139 million. Where are they raising money from, these zombie companies? Well, let's go find out. Cash flow statement says, proceeds from the issuance of stock, $37 million, $536 million, $139 million, and that's almost $750 million out of thin air. Because these zombie companies take advantage of the stock market at all-time highs. And it's scary. Because just issue stock, it makes sense. But that's how you misallocate resources. Because like with CoreWeave, you get a stock pump here because NVIDIA bails it out at, under $40. In case you didn't know that, by the way, it's another example of why you want to be part of the Alpha Report. You join once, you get lifetime access. But under $40, NVIDIA has a buy agreement for CoreWeave. NVIDIA is like literally a put option for CoreWeave under $40. And so every time they bounced under $40 or fell under $40 here, we're like, oh, NVIDIA is going to come buy them pretty soon. And, then of course they meme up to 187 because they can't go down. And so of course we haven't hit new all-time highs because that's the way momentum works. Is you hit your all-time high once off of momentum and you typically don't make it back there because people, as the stock goes up, people try to take profit or get out to get another chance to get greedy and get out. So The Economist is not wrong to say we're in a recession right now and people have somewhat forgotten of the pain of what could come. But, there are red flags. Look, for example, at the gold ratio. We were looking at that this morning and we're like, the copper to gold ratio, and we're like, oh, whoa. We haven't seen this ever in the history of the copper to gold ratio. Look at this. The copper to gold ratio, which is usually where, fear goes up, so the price of gold goes up, or gold isn't getting bought through momentum, who knows. And then the price of copper goes down because it's an industrial metal, so the price of copper goes down because people are producing less. And then so what happens? Well, first of all, you get this ratio that usually coincides with things like the COVID crash, the 2008 crash, the dot-com crash, the Volcker era, right? So usually downturns in the economy are when this ratio goes down. There are other times as well, like over here in 2016, you had a little soft patch over here. Nowhere near as low as like what you get in a crash though, typically. You could see the 82 crash over here. We got the 82 dump over here. You got the 1980 dump over here. That's your double Volcker rug pull, right? And then in like productive eras, you tend to see an explosion of this. So you see, in 2005, you get this explosion of this ratio, or in 1988, as the economy's booming because the industrial metal of copper is doing really well, people aren't seeking shelter in gold. But who knows? Maybe this ratio is just skewed right now, the lowest level in the history of the ratio. Like I couldn't go. I mean, I could go back even further to like the 1800s. It doesn't get this low. It's insane. There's the lowest ratio ever, which is typically associated with recessionary environment. It's like a canary in the coal mine. Now, I know we get tired of talking about jobs. You know, there's no surprise we talk about it, like I feel like on a daily basis. But it's reasonable to talk about jobs because, again, we got ADP jobs data this morning that isn't good. And then, of course, we have this negative catalyst now coming up. And the doomers just corrected themselves because just the other day, they're like, oh, you know, we haven't actually hit levels of spending like we saw in the dot-com bubble for artificial intelligence CapEx. And I thought it was interesting because I'm like, I don't know, man, like these companies are, you know, pretty negative cash flow right now. Now, I'm not calling for like a pop to the AI bubble tomorrow. No, timing that is challenging. I don't want to encourage people to like go into shorts and get burned. I think shorting this market is really hard. So I think you're better off just like, if it's going to be a red day, sit out, right? If it's going to be a green day, like that's when you go in. This is more of my opinion. That's been our, like the trading strategy in the Alpha report. Obviously, you know, predicated on lines that we look for. Short if you want, obviously. But anyway, what's remarkable is when we actually look at what the Doomers just said, the Doomers just told us that S&P 500 firms relative to sales have not hit their 2000 levels. S&P 500 companies relative to GDP have not hit 2000 level multiples. But compared to net income, we've already exceeded the 2000 multiples. So it's sort of like, is this time different or is it all the same? It's a little doomery, right? So, I don't know. But what I would say is we now have to pay attention to this economic data that's coming out probably before the Fed meeting. They'll probably try to rush it out. And I find that to be, it will be a big clearing event. And so this is, I think, we might actually have the pendulum kind of flip, right? So the way to think about it is the pendulum flips on reopen, right? Once data comes out, we get September, October, and November in rapid succession for jobs. We'll literally be getting a 3-month moving average of data. You know how they're always like 1 month doesn't make a trend. Oh, we need multiple months or whatever to get the data together or whatever. Like we need a trend. You will literally get a new 3-month moving average, which is insane to get all of that at the same time. That is going to be, you know, outside of Liberation Day, this could be the biggest catalyst of the year. And it could go either way. The trend is bad, but it could also clear the bad, because if, you know, we add back in government jobs and the trend starts moving up again, it's not what we're seeing with Challenger, it's not what we're seeing with ADP reports, but technically you could fall towards soft landing. So this is a crazy catalyst, and I would argue is probably the riskiest time to be in margin, because if we get a bad trend, like if this, let's put it this way, okay, let's just analyze it. If the 3-month moving average goes to negative 25 to negative 50K, let's say, there's no way you can argue we're still at break-even labor, right? 0 to 20K, we can argue break-even. If we fall below that, it's recessionary. Now, what does that do? That gives us rate cuts, guarantees December cut, but it won't be enough. And it won't be soon enough either. So it's going to be wild. You could get some really nasty, if you have 3 months of negative 25 to 50, I would also argue you probably get your treasury yields down substantially. You know, that's the other thing that'll happen, which is wild. But if that happens, you know, expect the 10-year to plummet. And then what happens when the 10-year plummets? Well, then mortgage rates plummet. And if on top of that, then they come out with the 30 or the 50-year mortgage, dude, that's gonna be great for real estate. Great for real estate in low supply markets, like, you know, the West Coast, where they just don't build homes. So that would be fantastic. The 50-year mortgage is already a tailwind for companies like House Hack. I honestly, I think that's why we are currently at 3x the average rate of fundraising for House Hack. So in August, not all of these are fundraise dollars, but I would argue that it's probably somewhere around, I mean, I'll show it to you. I'll just put it up on screen. I would argue that it's probably 95% fundraising, this number, because we don't include rents in this bank account because rents go into a different bank account. But look at this. This is crazy. I'll just put this up on screen. I don't think this is like proprietary information or whatever. But if most of this is fundraising, it's worth looking at it. So look at this. We're at 1.1 million in August, 881K in September, 1.4 in October. That gives you sort of a 3-month baseline, right? Dude, we're already at almost $1 million for November. That's crazy. And we're only, what, 10 days into November? And mind you, that I think includes 2 weekends and today as a banking holiday. Yeah, the 1st and 2nd was a weekend, and the 8th and 9th was a weekend. So 4 out of the last 10 days that banks have been open have been weekend days. And today banks are closed. So it's crazy. I mean, we're really grateful. Thank you. Dear SEC and investors, make sure to read the offering circular. This is not a solicitation. But I think there's some desire to just diversify away from markets and maybe margin right now. I don't know. And look at like a risk asset like Bitcoin. You've got this sort of bizarre situation now where Michael Saylor goes and buys. What did he just buy? He just bought like 400 something Bitcoin. And of course he, pumps up the price of Bitcoin beforehand. Where was it? Right here. 487 Bitcoin bought for $50 million. It's actually surprising that they weren't able to buy more than $50 million. That's kind of a low fundraise. Mind you, right before that, he tweets buy now, which is, I guess we'll call it outsider trading. Whatever. It's not market manipulation at all, I'm sure. But anyway, then buys, so he can, say, see, I was right. You should always listen to me when I say buy. And then every day after that, he's like, first, get the Bitcoin. It sort of turns into this like meme of like, buy Bitcoin. But as a risk asset, if Bitcoin is a little bit of a warning sign, you could see that despite all of this, it's been, at least in the last few weeks here, has been struggling a little bit. This is since October. Go to the day chart. Obviously, it's done very well since Liberation Day, as many things have. But this right here is interesting. So you got a little bit of an extended downtrend right here. And we really need to hold this line right here. I made it an orange line because I actually think it's a pretty legendary line. World of Warcraft reference. 102, 164. That's what we really got to hold here. Well, so far we've recovered, but I wonder how much of this was supported by Saylor buying. So, something possibly to be careful of. Somebody here in the chat Jackie just donated $5 to say, so are you shorting NVIDIA or Palantir or not, Kevin? Well, I mean, I don't know if you just listened to what I said like 5 minutes ago, where I said this is a very challenging environment to short. It's desirable to, because the numbers are crazy, right? But the thing is, if you get this data catalyst, then it's good. The market's going to rocket. And you could kind of keep the AI data spend going for a while. So I'm so midpoint right now. And usually I pick a side. But like if that data rolls over on jobs, yeah, man, it's all going to tank fast. Because then people actually start pricing in a recession, which markets are not pricing in a recession right now. I mean, how do we know markets are not pricing in a recession? Well, you could actually look at the projected rate for, the next multiple years. And the implied Fed funds rate, which if you saw a recession, you would expect it to go to 0, right? The curve for the Fed funds rate right now takes you down to from 3.7 in December to 3.5 in March to 3.25 in June to 3 in October, 3 in December of 26, 3 in 27. All of 27, it's at 3. All of 28, it's sitting at 3. So the curve basically goes, we go down to 3% interest rates and we stay there. That's it. That's what the market is assuming right now. So the market basically is not pricing in a recession at all. Because if you price in a recession, you would see a collapse of that to 0. Like if we were pricing in a recession next summer, you would see a collapse of that to a 0 Fed funds rate. So from, 3.7 or whatever to 0. And then you'd see the curve come back up because people would start pricing in the recovery after the recession. So you'd see it go back to, say, 2% or something. None of that is in the curve at all right now. The fact that we are at a coin toss for December tells you nobody's pricing in recession. Hopefully not. It's kind of crazy, right? But yeah, no. The tough thing about shorting is it's if you're getting options, you're paying theta. If you're on margin, you're paying interest. And you're sitting there like waiting and hoping to be right. And there's no difference between being wrong on your timing than being wrong on the thesis. Like at some point, there'll be a collapse in valuations, but pinpointing that is hard. All I'm saying is we got a huge potential catalyst that could tell you that the time is now for the flip coming up in the next few weeks. So that's why I'm I urge caution. Be careful because it's such a huge freaking catalyst. And every time we get the data, it's worse. So far, it's just every piece of data on jobs is worse and worse and worse. The Goldman piece doesn't help at all. So somebody's asking here in the chat, when do you think we're going to get the data? Before the Fed meeting. So before the 9th. You'll know we're in recession when we start re-rating stocks. Well, that's the thing. It's like, financial conditions are weighed heavily right now off of the price of stocks and stock valuations. If stocks tank, then the last thing that's basically keeping us out of an official recession is gone. And then you'll probably accelerate firings as well. It's just a disaster. But the good news is, knock on wood, still make money with the Alpha Report every day. Come join us. No guarantees, but we do our best every single day. And that CoreWeave call today just literally could not have been more perfect. In pre-market, we're going up. I'm leaning bearish. It's probably going to $90. Is there a chance it'll go to 105? Sure, but it's not the way I lean. Somebody bluntly asked me, what if we go up, Kevin? I go, well, sure, but that's not what I think is going to happen. And sure enough, we went straight to the line. It double bounced it. Now, the next test, by the way, will be what happens at close. Are institutions going to buy the dip or are they going to dump? Well, you have to take a look. All right. Cool. Love from Canada. Signed Josh. What up, Josh? Canada. All right, what we got over here?
4% one that lasted for seconds, and then it was.
Alex says, love you, man, but I think you're getting too biased on certain topics. Why don't you tell me, A, what certain topic you're talking about, B, why? See, it kind of makes you look foolish to say those things without providing evidence. You must take a logic class, and in a logic class you will learn to make a true argument. You must provide a claim and evidence. Now, the evidence could be disputed, which could then weaken your claim. But if you provide only claim and no evidence, you fail Logic 101.
We kind of need that test of that right now.
Yeah, and even if it's just a test, or to even just clear it out from the next 100 feet of road and have the catalyst out of the way. You look back at the last 2 quarters, the broad market did not really have a reaction to NVIDIA's numbers. We just kind of got beyond it and focused on what the market probably wanted to focus on anyway.
All right, I'll see you at 3. And we will focus on the final hour of trade with Mike Santoli. We'll do finals next.
Boring. We're not at the final hour, by the way.
change over time in their personality.
I feel like the technology is going to move faster than our cultural ability to adapt to that well. And that makes me not Luddite, but it makes me nervous about the culture.
I have one question, though, that goes a little bit off of this, Dagan, so feel free to answer this question or go in a different direction. But I'm thinking about Elon Musk as the leader and the person who's going to bring this to us with $1 trillion pay package. And I got to know him better, even though it didn't end well through his time at Doge and working with the president and those press conferences and seeing him interact with his kids and also seeing the results that he was able to bring for the American people. I enjoyed getting to know Elon Musk better. I became more of an Elon Musk fan. I'm wondering if that is true for others that watch that.
I don't know. I find him inscrutable. So that you might have a better human relationship with Optimus than you would have with Elon if you spend a lot of time with him. I don't mean to insult him. I'm trying to make a joke. But so Elon, the goal's going to be, what, 1 million of these robots a year, 10 million annually in Texas, ramping up. That's production. Who's buying them? Because I talked to a tech executive this morning who is a fan of Elon Musk and said, I don't know anyone who wants one of these. Asia has...
Everybody wants a freaking Optimus robot. What tech executive did you talk to? You freaking smoking crack. Anyway, which mug is better? The Bowser mug? Or this one? Anyway, this lady's nuts, dude.
Robots as housekeepers is already a company that does this, but they're not fully autonomous. They sell robots. They're human operated.
Yeah.
And if you want to give your children nightmares for the rest of their lives, please buy one of those robots. I've seen them and they are terrifying.
I think, well, I know we have to go. Okay, we'll save it for next.
We'll save it. Charles Payne, thank you. Always.
Thanks a lot.
Yeah. All right. Coming up, a breakthrough in Washington. The White House throws its support behind a deal that could reopen the government. That's next.
And right now, there are solutions available to be able to have increased insurance coverage for uninsured depositors. At our bank, we have less than 10% of our depositors that are uninsured, so this would be very limited in how it really affects small bank customers. It also hasn't been detailed how these costs would be implemented and how the funding of the deposit insurance fund would be filled, because there is an exemption in this current bill from funding it immediately.
Gotcha. And before I let you go, Jill, of course, it's Veterans
Day. That was QXO. Somebody just donated. Like, go look at QXO. The hell is this? Got a crap load of volume, gotta say. $13 billion. Was this like a SPAC or something? I don't know. QXO. I mean, you're talking about 2035 targets. Dude, I don't go out that far. Roofing and waterproofing. Oh, okay. Building supplies. Oh, man. There's so much oversupply in Texas right now of building in Florida. That's a hard one to argue for. Quarterly report, 11.6. Certainly not going out 10 years with projections. But how are their revenues doing? Did they just go public via SPAC? They must have. And they're losing money. Because I don't think you could actually compare over this. They must have just gone public or something. Because that chart is crazy and it implies that they did. But anyway, I mean, if you look at the actual core business here, what do we have? I mean, I've got deferred income, long-term debt of $3 billion, accounts payable 1.2. We got plenty of cash from going public. Plenty of cash. Losing money, though. How is their gross profit? Gross profit's not good. 635 divided by 728. Yeah, 23% gross profit. Operating expenses is tanking them negative, but some of it because of amortization here and depreciation. Interest expense, yeah. Well, I don't know what's going on over here. What is this here? Merger plan. Oh yeah, there was some kind of merger. Okay. All right, yeah, that makes sense. Yeah, I mean, eventually housing will boom again, especially if they drop off, rates dump. That'd be great. Okie dokie. So what else do we have? Let's see here. Is Tesla able to get off its line yet? It is trying. It's trying. Okay. All right. Now we got to talk about, let's see, talked about that. Let's see here. What else have we here? The card thing is interesting. Could talk about that. Let's see if there's any other new news. Yeah, let's see if there's new news from the anyone. Go to like the information. Need information. No. No news here. No new news. No news here. Gloomy holiday season. Well, yeah, no kidding. Retail and transportation warehouses typically rush to hire as they staff up for the holidays, and let those workers go over. In the final 3 months of last year, the sector added 912,000 jobs. Provide an important source of money for low-income workers. Okay. Number of job seekers looking for holiday week was up 27%, but the number of job postings was down 15%. Oh my gosh. Yikes. There's your seasonal layoff. And usually, we should be hiring at the end of the year, the last 3 months. See what happens. Man. Okay. Now, let's take a peek at the 3 bucket thing. Visa rates. The buckets. Yeah, there it is. Okay, cool. All right, let's do a quick summary on that. It's soon possible that your credit card that you get rewards on could get rejected by the stores you go to. Take a look at this. There's a new Visa and MasterCard agreement that took 20 years to litigate. The Wall Street Journal first reported on it. It's since been covered a lot in financial media because people are wondering, how does something, first of all, take 20 years to litigate? Attorneys made literally a whole career off of this. But apparently the idea is that right now, companies, based on the credit card that people use, get charged different interchange fees. That's sort of like that disguised fee that the merchants pay when you go buy something. So you go to a local coffee shop and you use a certain preferred card, you might pay 2.4% or as much as 2.8% on a credit card. On lower expense cards, maybe cards that don't really offer you that many perks, the merchant may only get charged, let's say 1.6% or maybe as low as 1.3%. Well, there are 3 buckets of cards. The buckets of cards are commercial, premium, and standard consumer cards. And it's possible that companies might now, businesses that you go to might now say, hey, we're not interested in taking your Chase Sapphire card or your Amex Platinum. We'll only take a standard card. Now, Moody's makes the argument that you end up, by doing this, businesses might end up risking pissing people off, and then people don't end up spending at those businesses, which is possible. But most of the higher income credit card holders have multiple credit cards. So theoretically, they could switch to another credit card and pay. Now, what's wild about this is really what you do by doing this is you kind of screw small businesses again. I wrote this, I'm not gonna actually post it, but I wrote this comment. I sort of just wrote it out on the Wall Street Journal as a little template thing here in the comment section of the Wall Street Journal. I wrote that the competitive advantages of the big companies is that they can just go make their own credit cards. I mean, look at Robinhood, for example. Robinhood's 3% cashback card is not a sustainable credit card business. We know that because even in their financials, they tell us that they're basically losing money hand over fist on this credit card program. I mean, look at this. If you look right here, you could see on this lower section, you could see that Robinhood, which offers to, certain customers who qualify for it or get it, Robinhood offers a 3% yield on their credit card, which is great. You get 3% cash back. It's amazing on everything. No limits, right? It makes you want to sign up for Robinhood and hopefully get off the wait list. Well, their revenue on the credit card net is $24 million. Their expenses related to these credit cards, possibly with some other credit facilities, they're not very clear about that, are $24 million. So assuming most of this is credit card here, they make $0 on the credit card. But wait a minute, that doesn't even account for the loss reserves that they put aside for people not actually paying the $200 million that are outstanding on Robinhood Gold Card credit cards. So what you find is that Robinhood actually takes a $55 million allowance for credit losses, which means that Robinhood is basically losing $55 million on the Robinhood Gold Card, which, if they have $200 million outstanding on the card, is basically a fourth of all Robinhood Gold Card balances they're writing off for an assumption that there will be losses on these cards. So why would Robinhood do that? Well, to get you to sign up for Robinhood, of course, and hopefully get the card, because 3% back is good. Like, if you were at Robinhood, why would you not use the 3% card? It totally makes sense. Like, otherwise, you use like the Apple card and get 2% back, maybe 1% back. You could use the Citi Double Cash card and get 2% back. You could use the Venture X card and get, a little bit more than 2% back. Bank of America, if you have like 6-figure deposits, they'll give you like 2.5-ish% back, right? But the standard for cash back right now is somewhere between 2 and 2 and a bit %. Well, big companies can subsidize that. Like, think about this. One of the big advantages of a company like Amazon, or if you think about it, Target, is that these companies can actually incentivize you to get a 5% back store card. Like, I personally have a store card with Amazon, with Target, and with Lowe's. Because when I go shop at Lowe's, I get 5% back on top of the other discounts we get at Lowe's. If I go shop at Target, I get 5% back, or 5% off the ticket price, right? 5% back at Amazon. If I go buy something on Amazon that's $100, let's just, for simplicity, not include sales taxes. If I buy something for $100 at Amazon, and I get 5% off at Amazon, it costs me $95. If I go to a local store, a local business, and I buy something that's $100, and then the charge, or the local company, tries to pass on like a 2.5% credit card fee, then they're really charging me $102.50. Well, the difference between paying $95 and $102.5 is 7.9%. A little dyslexic there. That's a lot. So who loses in all of this is probably the small business that's like, dude, we can't afford all these credit card fees anymore. We're going to start rejecting premium cards, or we're going to have to charge people for the credit card transaction fee. Well, that just makes it even more expensive to go shop at a small business compared to like an Amazon, Target, or Lowe's, where they've actually, or a Robinhood, where they could totally take a loss on the credit card to basically step on small businesses and destroy small businesses. That sucks. So all of a sudden, you've got more of a reason not to go shop at small businesses. And it sucks because these are hardworking, American businesses who are trying to compete. See right here, more and more merchants, especially small businesses in recent years, have begun passing on the interchange fee to consumers. Now, some small businesses are starting to try to collect money through like PayPal or Zelle, which maybe that's good for PayPal. I was just saying for HouseHack, I was just paying for quartz countertops with Zelle, and there's no credit card fee there, So I mean, like, good for them. Because I just, when I do like Zelle or even PayPal or Venmo, I always put it like as friend because I don't want them to have to pay the fee, and it's like I don't need the payment protection bull crap, so I just say they're my friend, and then I don't pay the fee, and they don't pay a fee, and they're happy, and I'm happy, and it's like I'm not trying to dispute the charge with them because, like, I got the countertop. I'm looking at the countertop. It's in my property, right? So I was like, what's there to dispute? What do I need, a warranty on a quartz countertop? You know what I mean? So anyway, the point of this is, apparently this deal, per the Wall Street Journal editorial board, will cap the fee that can be charged for standard cards at 1.25%, which if you look over here, that's a reduction because some of the standard cards are at 1.65%. So there's a limit on the standard cards. So you're going to see a compression in the benefits that even standard cards give you. But the risk is that now you end up seeing premium cards get rejected at businesses. And they're like, hey, if you're going to pay with a premium card, we're just not going to take it. So that actually hurts potentially, not necessarily going to happen anytime soon, but it could happen, your Amex Platinums, your Chase Sapphire, Reserve kind of cards or whatever. Now, I'm all for Chase getting a big fat middle finger. Like, I love this. Look at this. Fox Business reporting that the Attorney General of Florida is now probing JP Morgan Chase over alleged debanking of Trump media. And they're basically saying, like, why did you debank Trump, like, right when he was in the middle of trying to fundraise for the Trump Media Group and the stock, going public or whatever, right? Closing the merger of it, because the SPAC was public before that. JP Morgan's getting investigated. I don't think we hate the big banks enough. I think the big banks, and this is just my opinion, but, and look, don't get me wrong, in 2022, at the end of 2022, I remember saying, guys, there's something weird going on. You might want to be cautious with small banks because there's something brewing. I didn't know what the hell it was, but to be transparent, I put money in Chase because I'm like, well, they're too big to fail. Then what happened? We literally went from the end of 2022. If you go watch my videos, like December 22, January 23, I'm like, I don't feel good about small banks right now. Really eerie, but what happened in March of 2023? Banking crisis. Who's too big to fail? JP Morgan. So it's a place to go to, like, for safety with your cash deposits, right? Now, of course, FDIC ended up bailing out all banks, which de facto means there's no more $250,000 FDIC limit. It's sort of like an infinite limit because they don't want banks to fail. They don't want depositors to lose their money, especially the rich tech bros over at Silicon Valley Bank that all got bailed out. But anyway, now what? Well, now you look and you see JP Morgan rug pulling companies like Tricolor, which maybe they deserved it. But I wouldn't be surprised if JP Morgan's going around rug pulling a bunch of other people's lines of credits, warehouse lines of credit, margin calling people, because they're getting nervous about the economy. And that's how it starts. That's how credit cycles start. The banks stop lending. They start getting more restrictive on how they lend. And that's why I say, like, you don't hate the big banks enough because when times are good, they'll lend to you like crazy, and they'll be your best friend. They'll take you on trips, they'll take you out on boat excursions, whatever. They will suck up to you if you got money and the times are good, because they want your debt. They want you to borrow. Times go bad, they rug you. And this is one of those times where we're like at one of those teeter-totters in the economy where, like, you don't want to be beholden to the banks right now. So like, sorry, that's like a whole tangent off of the Chase Sapphire, but I believe it. I mean, Wall Street Journal is literally talking about it. See, premium card users are in for a big surprise. Their JP Morgan Sapphire Reserve and many other rewards cards could soon get rejected by merchants. 20-year legal battle suggests that companies no longer have to, quote, honor all cards. I mean, I can kind of see, like, if you go to, like, Amazon, they might just say, hey, sorry, we don't take the Reserve card anymore. Makes sense to me, Or if you think about it, like if you go to, somebody says you're making me more and more jaded. I apologize. Like, I feel like the more and more we study on markets, the more you kind of have to be jaded. But it's good. Like, I actually think a lot of people who invest in HouseHack are very, very jaded people because they're educated and they've been screwed before. And they're like, all right. I mean, obviously, read the solicitation. There are risks with every investment. The video is not a solicitation. Read the offering circular. But it's like real estate-backed company. Worst case scenario, it's still backed by real estate. Do we trust investing in real estate and Kevin's ability to lead that, right? But like, you know, we get people that ask very smart and savvy questions. People are very like, I think in order to get through the world and through life, you have to kind of be a little jaded, right? You can, like, at the very least, know where your risks are, right? So like, I'm not saying don't go bank with Chase and don't have a warehouse line of credit. But like, let's say if I'm a roofer right now and I've got a $100,000 payroll line of credit, business line of credit with Chase, dude, I'd be shitting myself right now. Because if in 3 weeks we get a bad jobs report and then all of a sudden JP Morgan goes, yo, I'm freezing your line and I'm calling it due and payable in the next 60 days. I'm like, bro, you're going to bankrupt me. What's Chase going to say to me? They're not going to go, oh, sorry, we'll extend your line. No, they're going to go, sorry, bro. Peace. Then you're screwed. So, like, I'm not saying they're definitely going to do that. But I'm saying they can do that. And so, and it has happened. And it will happen again. And so that's why I have this mindset of, I would rather you be jaded and aware than get blindsided. Like if you have the line of credit and you're aware of the risk, great. But I think a lot of people, honestly, are not aware of how the banks can absolutely rug you. And that's the scariest part, is the real rug pull that could happen.
That would be, would that be a qualified mortgage, or are those available commercially?
They were for a time and then they weren't. So you might find a few people who have them, but by far the most common mortgage is, of course, the 30-year FRM, the fixed rate mortgage. And by the way, it would take legislation to implement a 50-year mortgage. I don't think this is going anywhere. I think this is some stray voltage, the idea of the day. But my broader point is I do think they're flailing here, and I think they'll continue to do so. By the way,
yeah, somebody's asking about Rigotti, INQ, and versus Google and IBM putting in serious money. These are different styles of quantum computing. See, this is the thing that people don't understand. Google and IBM are actual real quantum computing plays. Technology that's probably 10 years away. A lot of these other plays, the Rigottis or, I don't know, D-Waves or whatever, they're just selling you some, quote unquote, annealing quantum computer today, which is bullshit. That's why their revenues suck. And they're implying that they're like a cheap way to get a pure play exposure to quantum computing like IBM and Google without having the rest of the other business. And honestly, it's borderline fraudulent. Now, it's not fraudulent because they disclose it all in their papers, but nobody reads this shit. Sorry.
We know that rebate stimulus checks would have to be approved by Congress. I'm wondering how feasible you see this being and what that impact would be on the broader economy if it even gets approved.
I think it would be a heavy lift for Congress. Even Republicans, when they see the price tag, I think would balk. There were numerous analyses out yesterday showing that almost any way you cut it, this idea would absorb well over what the nation is collecting in tariff revenues right now, which is something in the 200 to 300 billion a year amount in terms of, the revenue collections from the customs. Remember, contrary to a lot of what the president says, the folks who pay the tariffs are the importers, the American companies that are importing these these goods, and that's why it shows up in our national accounts. And the stimulus checks to allegedly offset the costs from these tariffs, and there are real costs there. They are juicing inflation, particularly of imported goods, would swamp the amount of revenue, even though that's substantial revenue. This is a very expensive promise. So I doubt it would occur. I also think you have to be concerned about the Federal Reserve. I mean, they're kind of on a knife's edge there in terms of balancing a weakening job market and higher prices. They're looking at a nascent stagflationary environment. I think you'd be fighting the Fed big time if you tried to implement this policy.
Just about a minute left.
Yeah.
Here, Jared,
to issue stimulus checks at the same time the Fed's like trying to control inflation. That'd be crazy.
Of monthly BLS data. I just wonder where your head is on this. The Fed is kind of flying blind until the government can start churning out monthly job reports again. But this was a trajectory already in place. Where's the job market going to be a couple of months from now? And are you worried about this continued contraction?
I definitely am concerned about it, and I wrote about it this morning on my Substack about precisely this question. The title of my piece was, "Are Layoffs Accelerating?" And I concluded, based on a lot of private sector data, ADP, but one bit of public sector data, which is unemployment insurance claims
The answer is yes.
coming in, that it does look like layoffs are accelerating, but the trend is quite mild. So maybe flashing yellow, definitely not flashing red.
That's fair.
And that's a maybe on the yellow. I do think the unemployment rate is probably ticking up. And I would guess by the end of the year, it's a couple of, which is next month, actually, it's a couple of tenths higher than it is now.
All right. Jared Bernstein, chair of the White House Economic Council of Advisors under President Joe Biden and senior fellow for economic policy at the Center for American Progress. Thanks so much for joining us here on Bloomberg. Our political panel is on the way next. Stick with us. This is
Meet Your New PC.
I won't stick with you.
2017. These were just not conversations we were having at that point. Trade schools were not trade schools, vocational schools were not a popular option going forward. Now it's become part of the conversation more and more. And actually, when I was on the campaign trail, I was always heartened to hear how many young people I was interviewing who did go to vocational schools or did go to training schools. But there are efforts underway to expand those offerings. Obviously, I think that's important. But there's also still a cultural taboo that you need to go to college to be successful and gain the skills that you need in our high tech economy, et cetera. But part of what's going on is those types of majors like computer science, healthcare, that you think of more job-oriented are actually becoming more popular. But the question I have is, do you need a 4-year degree to learn how to code and to get the coding job that you want? I think that people are starting to think more creatively about this, and it's good. There should be different. I think Ford, for example, has a training program.
But you're talking about coding, which is different than the mechanic that the CEO of Ford is talking about here. And I'm just trying to understand and think about some of the things we talked about today. Taylor was talking about this anger in the Gen Z generation that both sides are rigged and that the system isn't working for them. And, what is it about them that's rejecting this?
Well, part of Gen Z is not rejecting it, right? You've got some of Gen Z that's flocking to this new space. We've seen that in some of the data. And then you have some of Gen Z, I think in like urban areas, especially with like the rich liberal elites who are really rebelling against it. They don't want to go this way. So I almost don't want to speak about Gen Z monolithically. I think there's a big difference. But one of the problems, I'll just say this as a parent because I have teenage kids. One of the challenges is the whole educational system is built to pave the way for your kids to go to college.
Yes.
The information is there. The schools put it right in front of your face. It's all set up. And I think that's brilliant by the people who want to perpetuate what's happening right now. I'm just saying, but if you want your kid to go a different direction, you just run into wall after wall. And I'm not in the trades, so I don't know how to navigate that well. I really need help for somebody to show me that. But schools don't want to do that. And Mike Rowe calls it a dignity of work problem. Go to a high school graduation and see who's on stage and ask yourself, the people getting the awards, are any of them going into plumbing or electric or auto mechanic or HVAC or anything? Answer, no.
No.
It's the people getting scholarships to four-year schools. And so when that's who's rewarded, then that dictates who pursues that path.
Right.
And it's not the best and the brightest because they think to get a pat on the back, they have to get a scholarship to a four-year school.
Kagan?
With respect to Mike Rowe, all of this is changing, and it's changing because of families and because of young people. Because those families and those young individuals are smart enough to know, I am not spending that money to go to a four-year school, and I'm not going to get out with a degree that is, one, valuable, certainly not worth what a family would pay for it, certainly not worth borrowing all that money, and it's certainly not valuable to me as a person. It is not those degrees, those experiences.
All right, that's boring. That's complaining about college. Dude, the Qs are actually recovering nicely right now, which is good. So good recovery here on the Qs. Looks like we bounced at 617. Corey's still at $90 right here. Look at that. On the freaking line. Nvidia's recovering with it, which is nice. AMD. Rigotti Spaghetti's down. Dave & Buster's is up 4. Restoration Hardware is up 6. Trex Stecking's up. Apple's up. Wow, 174 now. That's a woo. Oh, bounced within like 10 cents of my line over there. Then you've got Tesla still down a couple. Decent recovery right here. Not seeing it as much on Bitcoin, but not bad. Not bad. All right, cool. I gotta go. Thanks for being here. Got some work to do with HouseHack. Go check it out. HouseHack.com or reinvest.co. Get your course member analysis and the stocks we were looking at this morning. Big analysis over at meetkevin.com. Use that coupon code. We'll see you in the next one. Next coupon expires on NVIDIA earnings day, which is coming up. All right, folks, we'll see you.